Hey, what's going on? Hope everyone's good. So, for those who don't know, haven't heard us mention it in the previous videos or in the previous posts, we're doing Mondays and Thursdays, 7 p.m. That's going to be regular appointment viewing. Some will be shorter than others, some will be longer than others. Like, there's not a set time, like, it's not like 7 to 8, 7 to 9, whatever. Sometimes it might be super short, it might be like half hour. Sometimes it might be like 3 hours. We'll see. But I feel like I don't want to try to promise like a guaranteed amount of time. You know, maybe we'll kind of see what they average out to be, and then whatever the average ends up being, we'll make that the regular time. But I am trying to make less promises these days, and then plan the promise badly and end up breaking them. I'd rather under promise and over deliver. So yeah, that's where we are right now. And today, some days we're going to talk about like media and culture. Some days we're going to talk about like business, and then we'll and other times intersect, or we'll have like free for all miscellaneous episodes. We're just react to a bunch of things that are not quite big enough to make a whole episode around, but I think it's too interesting not to talk about. So hey, what's up, Lens? We're trying to get on the road to remonetization, so the commenting, liking, subscribing, all that helps. Please definitely do that. We got demonetized from inactivity. These are various ways to support the show, from PayPal, champagnesharks@gmail.com, Venmo and CashApp, Champagne Sharks, and patreon.com/champagne sharks. And then, of course, there's the website, champagnesharks.com, which has links to every way to support us. So, yeah. So everyone hit like. It's not that many people here yet, but hit like anyway. And we're going to talk about the economy and the market and the AI bubble, and my thoughts on it. And there's a couple of things. I made that PowerPoint, and I like the PowerPoint that I made for the episode about the economy and the markets and how I think about them. And there were a couple of slides that I feel like I kind of left off. I didn't think about the time. So I think I'm going to keep working on that slideshow, revisit it, that PowerPoint, and then I'm going to make it eventually available for download. But I'm treating it like a work in progress, because I thought of a couple of things that I want to add to it. But one thing I want to talk about is how, um, I talked in the past about how various narratives are just like what I call thought terminating cliches. And one is like the algos. People bring up the algos did it, the algorithms, the high frequency traders. And I want to say, I think it's like kind of crap. Like, I feel like there's nothing useful to be done with that claim. Like, okay, if the stock market went down 10 points because of the algorithm, or it went down 10 points because of humans, it doesn't make me lose or not make me lose any more, any less money, like being down like 10% from an algorithm or 10% from humans, that's still down, it's still the same amount of money. Like I don't understand the point of it. Like, if something happened in the market and it caused something to go down a certain amount, uh, what the hell do I care if it came from algorithms or humans? Uh, that's still information I should be working with. Like, I feel like people say that algorithms or high frequency trading desks and all that stuff because they don't want to admit a theory is not working. They don't want to admit that the market isn't as logical or rational as they want to believe. So, they get to just say, hey, the algorithms are the rational ones and the humans are still making sense. And when the market's doing the things that you want it to do, those algorithms are still leading the way. Like, why is it only algorithms when is doing what you don't like, or when it's messing with your theory. Whenever your theory is being proven right, whenever it's working out, I never hear anybody say, yeah, those algorithms really went my way today. Like, somehow these algorithms are only there when things are going your way. And the other thing is too, right? Like, if I'm in a crowded movie theater and a human being yells fire in the crowded movie theater, or a robot yells fire, like somebody places a robot in the crowded movie theater and he yells fire in a convincingly human voice, the stampede by humans following the screaming of fire is still going to be the same. You know, I'm still at danger of getting crushed regardless. And that's the other silly thing about the whole this algorithms thing. Like, even if the algorithm is the one yelling fire first, or a human is yelling fire first, it's still going to spark the cascade of panic by the humans in the theater that's going to make it indistinguishable from however it started. You know, I don't really see the point of these differentiations. The other thing that people say, the other thought terminating cliche is priced in. Like, whenever something doesn't make sense that happened in the market, they just say, oh, well, that news is priced in. So it's just non-falsifiable, like, you can never be wrong type of dynamic. It becomes like, hey, if the market does what I want in response to this news, if the market does something logical in response to this news, then, you know, I can say, hey, the markets are rational. If the market does the opposite of what the news should have made the market do, I can just say the market is rational. It just already priced this in. So now it's doing the opposite. And it's like, you can't prove it. A lot of times we look at these so-called priced in things, you would think some kind of equilibrium would end up being reached, but it's like, it's not happening. If you try to really look at the evidence, there's no proof that this priced in thing is real. Like, nobody really examines these things. You just say them just so that you don't have to really think too hard about what you believe and your premises and stuff. So yeah, when people, like, you know, say things like, hey, I heard that the algorithms did that. It's like, well, who cares who did it? The effect happened. There was a cause and effect. And it all ends up in the same place anyway. If the humans start a behavior and cause a stock to drop, you know, the algorithms are gonna follow the humans' lead and react to the humans. If the algorithms start the trend, then the humans are gonna follow the algorithm. Like, at the end of the day, like, we can't really piece all this stuff together. All I know is this is all you need to care about. X action happened, Y action happened in response. That means X very likely leads to Y. I don't care if algorithm did it. I don't care if, I just think it's all fruitless conversation, especially because it's always used. I mean, that's how people argue now. Like, you know, like, I'll see people say dumb things on, like, social media and Reddit all the time. Like, someone makes a very good point, and it's like, well, that's subjective. That's your opinion. That's not, you know, objective fact. And then the person will act like a little baby and be like, you know, you're acting like your opinion is subjective fact. And you look at it, it's like, where did this person act like their opinion is subjective fact? They just gave, like, does somebody have to put, by the way, I want you to know this is my opinion, not objective fact. I didn't find this in an almanac or an encyclopedia about if this album is good or not, you know? But that person will never say that about somebody who agrees with them. Like if somebody says something that they like, hey, this album is great. I love this artist. This album is the best. This movie is the best. The person will never say, hey, I agree with you, but I just want to say that's subjective and you're acting like you're, no, they just jump in. Somehow it's only this belief that people are pretending that they're there's only this claim that people are pretending their subjective opinions are actually objective fact whenever that person happens to disagree with you, but you also don't really have the tools or inclination to defend whatever you like on the merits. You create this decoy objection. And I feel like that's the same with these kind of thought terminating cliches of price thin and algos. So whenever someone tells you that, I would take them instantly a little bit less seriously. I think it's a very pointless thing, and it's something that you're going to see all the time. Yeah, cool. So oh, thank you. Thanks, everybody. So I'm just looking at what everyone is saying. Yeah, yeah. I mean, we're definitely gonna be aiming to do that. Definitely follow. Tell your friends too. It definitely helps. More subscriptions, all that stuff. It helps us get up in the algorithm and all that. I mean, supposedly that's what they say. I don't know. But yeah. Oh yeah. Forget about all the slop content that's out there. It's kind of crazy. Yeah, yeah. Okay. So anyway, let me get to the stuff that we're gonna talk about. I'm gonna give you one example. This wasn't something I planned, but um, okay. The thing that I wanted to talk about is already here. We go. I'm gonna give you an example. So this guy is somebody who tends to be bullish. He's bullish a lot, and he's saying that the market's gonna turn around. Tell me if you can hear. Tell me if you can hear the stream.
I don't know about you guys, but basically everywhere I looked over this weekend, whether it was
Let me make sure that the sound is on. Hold on. Oh yeah, the sound is on. Okay, let's continue.
X or Reddit or YouTube, etc., everyone wants a crash. I mean, as John CMT here on X says, literally everyone wants a crash.
Okay, fair.
It's no surprise that everyone sounds bearish. Look at the put to call ratio. I mean, these kind of levels typically coincide with bottoms, not crashes. But I will admit, typically you don't have a software apocalypse and a tech crisis coinciding with the S&P down less than 2%.
And what he's saying there to give the bearish case more credence is that there's still a long way to go down as one of the factors of why this might be a real crash, because things have gotten so bad and we're still only like 1 to 2% from all-time highs. So that's a lot of room to go down. Like crashes usually take the market down like 20-30%
from all-time highs. So what is going on here? What is about to happen? And what's in store this week? We do have potentially a massive catalyst coming later this week. Before we get started today, hit that like button as well as subscribe to the channel if you find value out of today's episode. Okay, so first things first, before we get into the big catalyst coming later this week, the economic data and all of that, I want to give you my thesis here, okay? I don't really think it's a thesis. Algorithms are controlling this market. There is reason for some software companies to be under more scrutiny.
So algorithms are controlling the market. Why are they controlling the market any more than any other time?
Okay. Especially the applications of software. But there's a lot of software companies that are just, getting thrown out with the bathwater, right?
Okay, so a lot of good, rational software companies with great business are getting thrown out with the bathwater because everyone's overreacting to everything. Yeah, but why can't humans be doing that? Like, just because you think it's irrational and shouldn't be going down, and you want to believe that the market goes up for rational reasons, therefore it must go down for rational reasons. You want to convince yourself that it's humans are doing the right thing, and the market normally goes by rationality and objective reality, but there's this subjective algorithms. Like these algorithms are programmed by some of the biggest quantitative and fundamentals analyzing geniuses on Earth. So why would these people program the algorithms to do nonsense? I don't know. Maybe there is some truth to this, but nobody ever really explains to me why the algorithms would be particularly less logical than human beings. Like, have you ever been on a message board or a Reddit board or the comment section of, a finance article or whatever? Like, there's no reason for me to believe that these investors or on finance Twitter are these rational, objective geniuses compared to these machines.
Like a UiPath, like a Palantir, these orchestration layers, the brains of a lot of operations that are just getting thrown out alongside a Monday.com or Adobe, these stocks that Wall Street has long deemed to be systemically at risk from AI. So there's a lot of opportunities within this market when algorithms are indiscriminately selling tech.
So the algorithms are indiscriminately selling. It's not humans indiscriminately. So there's plenty of opportunity. But okay, even if you're right, let's say algorithms are doing it and not humans. Why should I believe that algorithms won't keep doing it? Are the algorithms going away? Are the algorithms, or is the programming being changed? Like, all I care about is that these things are going down. Right now, I agree that software is extremely oversold. I don't agree it's because of algorithms as some kind of specific target. I think people were just an insane mob when it came to buying this stuff. And now they're being scared with the same level of insanity and irrationality. Like, they ran into this not thinking it through. So, of course, they're going to run out of it not thinking it through. And people just overreact in both directions because they're an insane hype chasing mob. Whether it's and the proportion of that mob that you think is an algorithm versus a human being clicking a button versus a hedge fund, I don't care. All I care about is that this is what they're all doing. You can sort it out later. Who yelled fire first? If it was a robot or a human. All I know is that somebody yelled fire first, and I know where I don't want to stand. That's all I care about. Everything else is just being pedantic and coping. So that's all I'm gonna put in that video. So I'll give you an example of this kind of algorithm talk. I just don't understand what's the point of it. I mean, he's just basically, to me, just saying that as an excuse to hold on to his whatever his thesis about. He had this thesis on what the stock should do. He was investing in this bull market and had this idea of what it should do, and now it's not. He wanted to believe it was going up based on this theory, and because the underlying metrics of the companies and whatever didn't change. If anything, they had great earnings, and it's going against it. He needs a reason to kind of dispel the cognitive dissonance of the market was rewarding my theory because it's objectively true. He needs something to keep that true, and this algorithm thing is that. So that's my advice to you. Don't care about algorithm talk. Don't care about priced in talk. All of it to me means nothing. I might make a list of thought terminating cliches in investing talk. Just give me a second. So what I want to talk about now is how things go from hype cycle to hype cycle in tech, and particularly the stock market, because the stock market has been so based on tech. This is, I think, a very good video. It's by Modern MBA. It's called Why AI is Tech's Latest Hoax. And we're going to play it now.
Tech is a sector unlike any other. It's an industry where individuals can turn into billionaires overnight, technical ideas supersede business fundamentals, and leaders are rewarded for showmanship over competence. In today's Silicon Valley, innovation is crowned, not earned, to those who can tell a story and look the part of an eccentric genius. Venture capitalists and founders are symbiotic.
And this is a great, example, because this is, I mentioned in that video that we did, that WeWork is not even really tech. One of the ways to get away with not having fundamentals for a lot of stuff, like that disease of growth over profit and the narrative over money making reality, is to make everything seem like a tech company. So, like, you have a taxi company like Uber or Lyft, you make it present as a tech company, because whatever premise you need, like this app. WeWork is the same thing. WeWork had even less reason to be treated like a tech company, but they got people that think of them like a tech company, and they started being valued similarly, and so on and so on.
VCs need radical ideas, and founders want to start businesses on someone else's dime. Unprofitable companies are kept alive with injections of capital, gamed valuations, and manufactured media hype with the goal of surviving long enough to IPO or be acquired. The inspirational speeches, motivational essays, generous salaries, and magazine spreads are no accident. It's all there by design to keep the talent pipeline of new grads flowing to the sector. Founders lean on VCs for access to capital, talent, and operational mentorship, while VCs lean on the founders to educate them on technology. But VCs aren't prophets. Most are former Wall Street bankers or celebrities who have never worked in tech.
I don't know if you know. Well, I think it's another great point too, is that a lot of these people do not understand technology at all. Like, I'm not somebody who's was trained in tech, but I've tried to be very cognizant of that and realize that, I don't know about these things, and to do my best not to go with the popular narratives, and understand that the people reporting most of the time don't understand these things. And you see it a lot with this stuff. Like right now, this insane idea, they're calling the SaaS apocalypse, SaaS, the type of software that is done in companies like Workday and ServiceNow and Adobe and all these other, I think Monday.com is another one. Like all these software companies went into the toilet because these AI guys claim that AI is going to replace everything that these companies do, and no one's gonna all these corporations are going to stop hiring the software companies. Everyone's going to throw software out the window and just use AI to replace all these things. So these things are crazy oversold, just on the say so of the head of Anthropic. And it's like, even if this stuff does work, for like the vibe coding and all that stuff, people aren't actually paying these companies just to get a software. You're paying the company for the support. You're paying the company to have someone at your beck and call to help you when you have problems, when things don't work, to give you patches, to have access to all your information on the server, and to help you recover things that are lost and whatever. If you just give people an AI tool and just be like, here, have at it, and you have to manage all this stuff in-house yourself, that's prohibitively expensive. But if you talk to people who are actual tech experts, who work in these IT departments, who work in these fields, they'll tell you that, like, but yeah, I've seen the craziest things go viral supporting this thing, and then the people who are sending this stuff around are qualified to even talk about this stuff, but they make a plausible sounding case. And you see all these like investing gurus and CNBC experts and whatever just go on CNBC and just repeat this stuff. And it's like, just because you're an investor and knows about business doesn't mean you're an expert in everything. This is something I realized as a lawyer. As a lawyer, when I work on cases, a lot of times I have to brief myself one day on pharmaceuticals, one day I got to brief myself on investment banking or whatever. And I can brief myself enough to analyze the documents for the case. But at the end of the day, I'm just kind of getting just enough knowledge to bluff my way through. And because I kind of have to. I have no time to become an in-depth expert on all this stuff, because I have to cover all different types of practice areas. And I don't think people realize that it's the same thing with these investment people. They may have a level of expertise on this stuff, as a layperson, but most of the time, but it's okay if you just admit it. But these people, they have to act like they know everything all the time. And then it's going to happen at some point. It's going to turn around and everyone's going to realize, oh, wait a minute, this wasn't true. And then all the experts are going to say the opposite. They're going to be the same experts who were saying the opposite like 6 months before. Kind of like how everybody is falling all over themselves to mention the circular accounting narrative, the depreciation narrative, and all this stuff with AI. But these are the same people who are laughing at the people saying this or ignoring the people who were saying this last year and dismissing them as cranks.
The story, but his initial decision to invest in WeWork took approximately 28 minutes, including when he got in, left, and drove in the car.
The minute that you start having to report publicly, you have to start playing games with your numbers, you have to start playing games with your growth, and usually the person that loses in that situation is the consumer. So for
I hate to admit, but I do agree with him there.
trying to create extraordinary experiences for consumers over time, the longer those companies can stay private, and by Masa coming in and enabling that, the more unbelievable the experience and more life-changing the experience will be for people.
It's the blind leading the blind, and both sides must perform to reach the same payday. When you win in tech, you win big. Hence, you only need to win once. This is why there is a near infinite pool of aspiring founders and VCs, and why both parties are so quick to forgive, reconcile, and work together on the next big thing. Yet whenever investors turn bearish on tech, it doesn't take long for the sector to come up with a new growth story. The most recent was in 2022, when the public markets soured on big data and SaaS. Starting in the early 2010s, Silicon Valley had championed.
So you said they soured on SaaS. SaaS is what I was just talking about. And what SaaS means is, like, how do I describe it? It's software as a service. So it's like it's software being provided to you as an ongoing service. Like you kind of like renting it instead of buying it and installing it, and you pay a subscription with the provider handles all the hosting, the updates, the maintenance. So things like Salesforce, Dropbox, Microsoft 365, things like that. Like you don't have to have the headache of managing and maintaining it yourself. And it's usually cloud-based. It lives on the provider servers, not your computer. So you don't have to host all this information on your own server. And they handle all the updates, the security, the server maintenance, and all this stuff. It's kind of like owning a home versus renting a home. If you own a home, you take all the headaches onto yourself, which is one of the reasons why I just think it's kind of silly to just think that giving people some AI software is going to just overnight replace SaaS.
Big data as a revolutionary technology that could unearth deep insights, hidden patterns, and innovation from massive amounts of data. Big data promised a new, sophisticated, data-driven world where one could precisely predict demand before it existed, trends before they started, and behavior before it occurred. And there was immense.
So this is going back to the days when big data was a big growth story. What tech does is just keep cycling out new growth stories. So first it was regular data, and there was SaaS. And then when that kind of hit a peak, we moved on to big data. So I'm going to back up just a little bit.
Big thing. Yet whenever investors turn bearish on tech, it doesn't take long for the sector to come up with a new growth story. The most recent was in 2022, when the public markets soured on big data and SaaS. Starting in the early 2010s, Silicon Valley had championed big data as a revolutionary technology that could unearth deep insights, hidden patterns, and innovation from massive amounts of data.
So right now we're at the 2010s.
Big data promised a new, sophisticated, data-driven world where one could precisely predict demand before it existed, trends before they started, and behavior before it occurred. And there was immense potential for the public and private sector. Police could prevent crime before it happened, researchers could detect cancer before it spread, and companies could optimize products, make correct decisions, and gain a powerful edge.
Understanding and innovating with data has the potential to change the way we do almost anything for the better.
There's a waterfall of information waiting to be tapped in your business's production data, log data, workflows, and more. You can unlock new patterns, drive new insights, and reinvent the way you do business.
The big data ecosystem is real. It's in the first inning of a 9
This is June 2014.
inning game. And in the next 5 years, there's virtually no aspect of our lives that isn't going to be affected.
Now, wouldn't it be great if you had a crystal ball where you could play back historical events and understand what happened in the past, what were some of the symptoms, what were some of the data points, to be able to predict what could happen?
And it's like a lot of this stuff comes from, sci-fi. Like I think a lot of these growth stories come from selling people on sci-fi. So it's kind of like just like Terminator 2, when a lot of those movies are what helped fuel the public imagination with AI. This stuff like, what's the Minority Report? What's the movie where the machine can crunch all that data and use it to predict who's going to commit crimes preemptively. I think it's Minority Report, but that's an example of the kind of sci-fi fantasy of big data. That if you have enough data analytics on people, you can just kind of predict anything under the sun, and then get recommendations to predict it. I mean, to handle it before it happens. So here it mentions predictive analytics and then prescriptive analytics, like what could or is likely to happen and what we can do about it. Like in The Wire, you saw big data with the CompStat, and how the cops were kind of slaves to these predictive giant data programs.
That's what today's topic is all about. How do we find insights and also foresight to make better, well-informed decisions?
Think what happens when we collect all of that data and we can put it together in order to find patterns we wouldn't see before. This, I would suggest, perhaps it will take a while, but this will drive a revolution.
Because all of a sudden there's a lot of data about people, right? That comes from cell phones, comes from credit cards, comes from other things like that. And of course, people drive society, their wants, their habits, their fads. And so all of a sudden you get to the point where you can begin understanding people in a way we've never been able to before.
Imagine a world where we can predict storms and natural disasters with a much higher degree of accuracy and get people out of harm's way much sooner. The opportunity to be able to have a significant impact on mankind is huge, and quite frankly, it's why I'm so passionate and why I spend all my time working in this area of big data and analytics.
Industry after industry is becoming more intense, more competitive, nastier place to do business, basically. And this is only going to increase as we move deeper into the era of big data. When the better answer comes along, stop listening to the hippos and start listening to the geeks.
Big data was a movement as much as a technology. Yet
that's a great way to put it. It really was like a movement. And I'll go further and say it was almost like a cult. Like a lot of these waves, these investment waves, are not just movements, but outright cults, which is why, thought terminating cliches pop up so much.
Markets started to question if any of these promises were real, as the vast majority of consumer startups and SaaS companies were still bleeding years after their IPO. Even in the most favorable, low-interest business conditions in history, there were barely any winners to point to. Out of nowhere, ChatGPT was released, and AI became Silicon Valley's new growth story. In less than 2 years, everyone has forgotten about big data and SaaS. Every tech company is now an AI company. Every Fortune 500 needs an AI strategy. VCs are only investing in AI startups. Everyone's title on LinkedIn mentions AI, and every product is an AI product. To maintain hype, AI was brought to the public sector. Silicon Valley figureheads put on a performance in front of Congress, begging for regulation, urging protection for workers whose jobs would be displaced, and fear-mongering about an apocalypse. This song and dance was done over and over again until the White House was spooked.
We've done it for other industries. I mean, the IAEA did it, and I think this is a technology that we should treat with that level of seriousness. So although difficult, I think it's important to try to start the conversation on it. I mean, an AI that could help design novel biological pathogens, an AI that could hack into computer systems, I think these are all scary. But these systems can become quite powerful, which is why I was happy to be here today and why I think this is so important.
But more importantly, the public was convinced of the immense potential of AI, and people continue to speculate to this day with great conviction that artists, animators, translators, and programmers are all next in line to lose their jobs. This episode is not a technical debate, but rather a deep dive into how AI is just the latest tale spun by Silicon Valley to keep valuations high and the outlook positive. Before AI, there was crypto, Web3, blockchain, virtual reality, augmented reality, big data, IoT, and wearables, all supposedly revolutionary technologies that have never lived up to the hype. In this episode, we'll dive into the real market dynamics that push companies and individuals to jump headfirst into these trends, how this all started with big data, and why AI is ultimately just another pump and dump. This episode is sponsored by Kajabi, the ultimate all-in-one platform that helps entrepreneurs you need to build a profitable business. If you go to kajabi.com, the introduction of smartphones and tablets had created new markets. It was the advent.
So this can go even further back. I think it should actually just started here, but whatever.
Of the mobile internet, geolocation, 3G, and the App Store. More could be accomplished in this online world than ever before. You could now track the location of users, which was data that had never been available before. And if you designed for mobile, users would organically flock to you for that superior experience. Numerous startups emerged, eager to be the first movers on these platforms. One was Groupon, an online platform that sent out coupons for local businesses. Their pitch was that they were amassing unprecedented data on consumers and driving paying customers into the door for merchants, which is more than what Google or Facebook had to offer. Groupon knew where people lived, their age, interests, behavior, and they fed all that data into algorithms to send only the most relevant, enticing coupons. As the volume of coupons and merchants increased, the more data that was collected, and the faster Groupon could push customers to a business, and the more money that it would make. Pandora's story was identical to Groupon. They scientifically abstracted every song in existence down to 480 technical attributes. They collected data on each listener to figure out what they would like. They used proprietary algorithms to predict what music they'll like next, and they generated personalized playlists. The more listeners, the more data, the more accurate its algorithms would get at playing the right song at the right time for each.
I think this is, I really like how this is starting because it goes way, way back. So we can see how long this has been evolving and how long this idea of just the next big promise. So we have data, but it's not quite big data yet because it needs more users to make it big data. So I would call this kind of the cusp of the movement from data to big data.
Listener. Since Pandora knew the age, gender, and location of every user, they could sell to advertisers. Another popular app was Yelp, who asserted user data and network effects as their moat. Because Yelp knew who was looking for what and where, like Pandora, they sold these eyeballs to advertisers. Grubhub went in a different direction and focused on the takeout experience. Restaurants didn't need to build apps. Instead, they could just pay Grubhub and support online and mobile ordering overnight. And Grubhub had the algorithms and data to personalize feeds and predict what users wanted to eat when. Other first movers in this period were Etsy, Foursquare, Twitter, and WhatsApp. By the early 2010s, the narrative had broadened. Smartphones had gone mainstream, apps became common, and mobile experiences were the norm. It was at this time when Mark Andreessen published his famous essay, Why Software is Eating the World. The thesis was simple, that data was gold in this new digital world. Data could be applied to unlock business value, product optimization, and personalization in any industry. Users generated data, data-powered algorithms, and algorithms produced innovation. Zynga, the studio behind Farmville, proclaimed that they were innovators because of data. They looked at monetization, retention, and engagement every day to quantify what exactly got people hooked and to keep the whales spending. As Zynga amassed more users and more data, they alleged that their analytics would only become more precise and profitable. As an online furniture store, Wayfair offered a near infinite amount of furniture, styles, and brands. They talked up their real-time proprietary personalization, inventory, and pricing algorithms that would maximize profits on every piece of furniture. Chegg looked to do the same in education with a social network that collected data on high school students. While that product...
And the other thing with this stuff, too, is that it sounds so convincing and all-powerful and all-encompassing that it's kind of what I described in the other finance video that I did, that you kind of didn't need to really show the profits and the returns up front, because the promise of this just makes it sound like such domination that there's no way it's not going to be profitable. And everyone always keeps thinking about Amazon. Amazon is the example that worked, that makes everyone believe in every other example. It's like, yeah, Amazon wasn't profitable for quite a long time, but it kept growing and growing and dominating the space until it just became the best game in town. And it's economies of scale and its sheer amount of data and ability to predict the consumer and market to them just made it untouchable. Like, everyone just thought every new thing that's going to come out was going to be the Amazon of delivery, the Amazon of furniture, the Amazon of this. Everybody was afraid of missing out on the next Amazon.
Never succeeded. It was clear that Chegg's leaders understood the narrative. Quote, there is a playbook followed by many companies such as Facebook, LinkedIn, Netflix, or Spotify, which is to take a giant category, build products and services that consumers value, use technology to deliver them at scale, and leverage the data it generates. In the case of Facebook, it's social, LinkedIn professional, Netflix entertainment, and Spotify music. The advantages these companies have built through their data makes each of them very hard to compete against. If you own your customer...
And again, it's all started with Amazon, really. Like, in Amazon's case, it was books and eventually everything.
The channel of distribution, you collect data, you own that data, and you're able to use that data to improve your product, to monitor what people do, to deliver better products and services. You should be in the best position to provide overwhelming value to your customer base and to build a giant moat.
A moat is like, basically, a castle has water around it and you can't really get to it. It's like a competitive moat is like, it's hard to compete against you because you have such dominance and you're not easy to replace in this sphere.
Thousands of new consumer startups flooded the market backed by venture capital and seeing the same narrative that data was power. But these startups did not have the organic adoption and network effects that the first movers like Yelp, Pandora, LinkedIn, and Facebook had. As a result, they needed to spend millions of dollars on advertising just to acquire users. This chase for users and their data was used to justify the unsustainable marketing spend and broken unit economics.
Okay, so this is an example of how companies were forgiven for being bad in a traditional way, as far as like money out versus money in, based on, hey, we got to do this to get the data. To get the data, we're going to have to generate as much user data as we can. So we just have to get people buying and spending, and we'll worry about making the money back later. We're going to operate at a loss because we have to get these people through the door buying and selling.
The spin at the time was that all these startups were unprofitable by design, as they needed to acquire the necessary data to supercharge their product and business. There was
Unprofitable
Wish,
by
who boasted
design.
that its algorithms could get customers hooked on buying $1 junk online, and Opendoor, who bragged that they had so much data that their algorithms could value real estate better than humans and flip properties anywhere in the country for profit. Casper proclaimed that data powered their disruption of the mattress industry, and DoorDash asserted that it was data that enabled fast delivery, order routing, and strong earnings for gig workers. And then there was a firm who...
I mean, do you guys agree with me that it's easy to forget how crazy this era was? Like when I was watching this, I was like, wow, I really forgot just how much of a cult, big data was. But it really was like everywhere. I think maybe because I wasn't really investing that hard yet either. So I was only kind of casually keeping an eye on this.
Intended that they had the data to issue microloans for luxury purchases. These are just the startups that we covered in the past on Modern MBA. There were many more, like Blue Apron, who claimed that they had so much data that they knew every individual's taste profiles. They could algorithmically predict demand for any given meal kit and achieve production efficiencies that no one else could. Warby Parker pushed that they had data that no other optical company possessed, and that they were so data driven.
Yeah, this is very true. And if you Google an article by Derek Thompson about this, the millennial subsidy, which I think we've talked about before, he talks about all this too. It's so true. What Lens is saying in the comments here. Anytime I hear operator loss, I think of Uber. Rides on Uber were so cheap. Then one day, boom, no ride was less than $12 no matter the distance. And I think as the economy gets worse and worse, and there's less and less venture capital money, and people stop settling for these promises of trust me, bro, growth is coming. There's going to be more and more pulling back of the allowances. I think of what venture capital gives these companies as giant allowances. Like there's giant kids and they're being given these allowances, and it's like, hey, you haven't been doing good in school. You haven't been delivering the goods. And I'm pulling back the allowance. I'm grounding you. I'm taking back the car.
And that every pair of glasses would be a bestseller. Allbirds pounded that they knew more about customers than traditional sneaker brands, and over time would have higher margins and has many loyal...
Oh, I think Allbirds just went out of business, ironically enough.
Customers as Nike. Stitch Fix declared that they had more data on shoppers than any department store or fashion brand, and that its algorithms could accurately predict what clothes someone would buy sight unseen. TrueCar promised to transform car buying with algorithms that ingested every sale in history and could generate the most accurate price for any vehicle with a make, model, and year alone. Lemonade billed itself as a disruptor whose algorithms crunched so much data around the clock that they could process claims and underwrite policies faster and cheaper than traditional insurance companies. Lending Club crowed that it was their data that unlocked business efficiencies and in turn allowed them to issue lower interest loans online within minutes. SoFi trumpeted that they were collecting all the behavioral data on customers that conventional banks did not get, which would translate to better accuracy and greater profits as a lender. Fitbit disrupted health and fitness by quantifying and visualizing every individual's physical activity. Roku and Netflix both asserted that they had so much data as streamers that they understood viewers better than any film studio or cable network. They knew what people wanted to watch, and by extension had the secret sauce to make any show or movie a hit. These are just a few of the thousands of consumer startups that emerged in this period. If you look at the S1 filing of any consumer tech IPO of the past 15 years and search for the word data, you will see the same narrative spelled out. It was a convincing story. In what world would data not be useful? Yet contrary to what Silicon Valley advertises, tech is not a magical frontier where everyone can be a winner. The reality is that in every industry, there can only be a few winners. Yet no one could argue against the prosperity of Facebook, LinkedIn, Amazon, Google, Netflix, and Microsoft, who are all making a killing with data. Their earnings were snowballing in ways that the public markets had never seen before. The only thing more impressive than revenue was margins, which were the envy of the entire private sector. There was no other stock as reliable, valuable, and still high potential as FANG. If data was the moat for these tech leaders, why couldn't it work for a startup that was nimbler, faster, and more concentrated? If a startup could apply the same data playbook to a smaller industry and achieve just 1/10 of what Facebook or Netflix had accomplished, it would still be enough to IPO. With such high-flying results and thousands of VCs and startups all shouting the same story, data became fashionable. Every one of these consumer startups was crowned as...
Yeah, look at all these. It's kind of weird. Like, I feel like these magazines aren't even that popular anymore, but there's this era of like, Fast Company. What were the other ones? There were a bunch of magazines. Everyone used to buy them and just get swept up in these stories. There's Fortune, Forbes, Fast Company, and there's another one that's like Fast Company that I'm not thinking of.
An innovator based on their user growth alone, which was misleading given how much of it had been attained through heavy advertising and artificial subsidies. Data was billed as the means to unlock innovation, but beyond selling data to advertisers, no real business value had actually been discovered. By the mid-20s,
that went by pretty fast. I think it's worth rewinding. It also went by fast because I sped this up.
Achieve just 1/10 of what Facebook or Netflix had accomplished, it would still be enough to IPO. With such high-flying results and thousands of VCs and startups all shouting the same story, data became fashionable. Every one of these consumer startups was crowned as an innovator based on their user growth alone, which was misleading given how much of it had been attained through heavy advertising and artificial subsidies.
That was a great point that just mentioned in passing. They use user growth, which is an example like a vanity metric, a decontextualized alternative metric to like, just regular profit and loss that makes things sound more impressive than they are. And he said a lot of it was because of heavy marketing and user subsidies, which is very true. Like, that's one of the reasons why, people try to say AI is going to work because its use rate is bigger than say such and such was, but how many of those people are paying? How long can it last at this price? It's a very subsidized price. If it had this price that these, first of all, how many of them are paying, and at the price they're paying, can it stay profitable, or is eventually going to have to get more expensive. And if it gets more expensive, how elastic is that user base? Are they going to stay around at a higher price? It doesn't really mean anything, but the number is just there, so it sounds good.
Data was billed as the means to unlock innovation, but beyond selling data to advertisers, no real business value had actually been discovered. By the mid-2010s, many of these consumer startups were starting to flame out. The few that had gone public were losing just as much money, if not more, than...
Oh, this is great. Look at how all these things were losing money. Before this Magnificent Seven, it used to be the FANG. That's what people used to talk about. That acronym is kind of gone. It was Facebook, Apple, Amazon, Netflix, and Google. And then Tesla and Nvidia, ended up being considered along with it, and they became the Magnificent Seven. But yeah, look at all these things that were part of the consumer startup revolution. And a lot of these were big on being about data. Not all of them, but they're about leveraging data and network effects.
They had been at IPO years before. The premise of innovating through data seemed less convincing by the quarter. In response, Silicon Valley moved the goalposts once again. Data was still valuable. The problem was you just didn't have enough of it or the means to interpret it. Basic analytics and personalization was no longer enough. What you needed now was terabytes of data, sophisticated tools, and data scientists to get to the promise.
So this right here is the movement from data, as in lots of data, to big data. Big data is that next step. Big data is like, technically it's all big data. Like what we were talking about before is still a lot of data, but it's like, it's a slow build in the big picture. This big data is when it got really, really granular and huge. And we're talking about like terabytes.
This new trend was called big data. To maintain valuations and reputations, these consumer startups embrace Silicon Valley's latest narrative. Still,
so again, we've gone from data and software to big data.
Fortune 500 companies were all spooked. No CEO wanted to be caught with their pants down. No executive dared to say that they weren't data-driven. And every Wall Street analyst...
Now, see, like I said, everybody was afraid to not look like they were hopping on this trend. No CEO wanted to be looked with his pants down. What does that sound like? That the whole CapEx thing. Like people say, these people aren't dummies. Why would they be spending all of this if they didn't believe in this thing? It's because you can't afford to look like you're not doing this stuff. It's like an admission of failure. And God forbid, if it does work out for one of these other companies to spend all this money and work on AI, you're going to get fired and look like an idiot who ruined the company by not keeping up. But if it fails, you all fail together. So it's almost safer to just do what everyone's doing. And then worst case, everyone made the same mistake. How can anybody get really isolate you for being mad at, And then what you get if you win, if it does end up working out, is worth the risk of, being wrong, especially if you're going to be wrong in a group. But the other thing is, too, I think what a lot of these people do is they're stalling and hoping to hit a lick. You just keep stalling. Like, these people who are running with the data narrative and going with all that, when things started going wrong, during all that time, the new narrative, big data hit. So it was like they were saved. And we're going to see after big data, another lick. They hit another lick. So I think a lot of times these people just stall, try to stave off destruction, control narratives, lobby, politicians, get the media on their side, control the narrative, and hope to set up the next big thing, to bail them out when it's time. So I think it's another thing that is happening with AI and its CapEx. They're just hoping like just keep spending it, and we'll worry about it later. We'll think frantically of what the next narrative is going to be when the time comes. Hopefully, this won't flame out before that time.
Wanted to know how they were going to stop tech from eating their lunch, and the conversation quickly devolved into a pissing match of who had the most data and best culture. Groupon's newest CEO went all in. Quote, Groupon is in the data stream for every business transaction. We see every bit that comes through these businesses, which gives us really critical insights. We're rewriting our basic personalization and relevance with advanced techniques and machine learning. The secret to our methodology is a data-driven approach. We have more than 9 petabytes of data, and we A/B test every single feature. How many companies do this? Not a lot. None of this would stop Groupon from flaming out in just 5 years. Zynga. Quote, we have a really strong team of data scientists who look at the relationship between the ads we're serving, the number, type, unit, and impact on player engagement. We have developed specialized algorithms and machine learning. We're never going to have the same user data as Facebook, but we can get close. That's how we stand out when we're talking to advertisers with data science-focused engagement. Revenue improved, but Zynga remained as unsustainable as ever. Wayfair. Quote, we capture 4 terabytes of data every day and 40 billion customer actions a year. We have a depth of data rare within the home category.
Oh, I remember what the other magazines were. Business 2.0 and Red Herring, The Industry Standard, and Wired. Those are some of the other ones. There's another one called Upside and Inc. But I think Business 2.0 and Fast Company were the two like really hip ones. But let me just back up for a little bit.
Insights. We're rewriting our basic personalization and relevance with advanced techniques and machine learning. The secret to our methodology is a data-driven approach. We have more than 9 petabytes of data, and we A/B test every single feature. How many companies do this? Not a lot. None of this would stop Groupon from flaming out in just 5 years. Zynga. Quote, we have a really strong team of data scientists who look at the relationship between the ads we're serving, the number, type, unit, and impact on player engagement. We have developed specialized algorithms and machine learning. We're never going to have the same user data as Facebook, but we can get close. That's how we stand out when we're talking to advertisers with data science-focused engagement. Revenue improved, but Zynga remained as unsustainable as ever. Wayfair. Quote, we capture 4 terabytes of data every day and 40 billion customer actions a year. We have a depth of data rare within the home category. If you don't have the ability to take a
Yes, if you notice, all these go from, hey, we have the data to, they went from telling you all the stuff that you could do with data. They've already convinced you all the stuff that can happen if they have the data. Now they're moving to, you already know what we can do with data. Here's how much data we have. That means that all stuff that we promised that we can do during the data period, by telling you these sheer terabytes of it that we have, we can convince you of that we can do it better than anybody else, that we're going to corner the market on this. And it's just because more and more ridiculous amounts of data. And I'm sure a lot of you can kind of see the problem is going to end up happening. It's like, if it gets big and big enough, what amount of humans can realistically go through 4 terabytes of data? Do you know how much data that is? Like, how on earth do you even process all this?
Advantage and manipulate the data for deep analysis, it's tough. Over the last 4 years, we have built a team of 1,900 engineers and data scientists.
So 1,900 engineers and data scientists, but still 4 terabytes is a lot. And to make a coherent narrative out of it?
And machine learning influences our personalization, dynamic pricing, algorithmic merchandising, demand forecasting, and advertising. As a result, we've been able to build multiple platforms at a strong ROI. Deep analysis of data is central to our business and how we win customers. 6 years later, Wayfair has not stopped the bleeding and continues to lose nearly $1 billion every year. Blue Apron. Quote, our direct-to-consumer platform is our most valuable asset, which provides extensive behavioral insights to drive innovation. We have touched millions of customers and have a lot of data from our 6-year history. We use machine learning to give a sense of what customers are likely to order. This allows us to produce the proper amount of protein and produce, which directly impacts food costs and margins. None of this helped pull Blue Apron out of its downward spiral. Grubhub. Quote, we have data on over 100 million orders.
I keep noticing each of these companies ended up suffering as far as they could never make the promise come true of the money that they were going to make.
Our algorithms will get smarter about the most popular dishes in every neighborhood in 900 plus cities. There's no other company in the US that has this level of transactional data. The velocity of high quality, high fidelity data that we're aggregating is incredible at 70,000 points per day. The learnings from our massive troves of data and our data-driven insights will position us well for years to come. Grubhub's losses have deepened and its owners are still struggling to find anyone willing to take the company off their hands. Lending Club.
Yeah, you see that? I can't remember, this video is a couple years old, so it's not up-to-date information, but I think he does a great job showing how he did great research, shows all the promises that were made and how they all like went bust. But the stock price and the executive pay, a lot of people made a grip before the shit hit the fan. I'm sure some people probably got fired at some of these companies or had to move on, or the stock price eventually collapsed. I didn't follow the stock price history for all those companies, but you know, a lot of people kind of make money in the mess and then fail upwards, you know, before the shit totally hits the fan to do it somewhere else. So, you know, there's a lot of money to be made in the short run, even as a lot of this stuff goes wrong.
Quote, we've issued over $40 billion of personal loans in 10 years, so the data we have generated is really massive. That is a big data advantage. We simply have this big scale that allows us to slice and dice customer profiles, create unique experiences, and underwriting processes. We deploy the latest machine learning to derive more than 100 customized and behavioral attributes, half of which are proprietary and based on our unique data assets. Lending Club has since cratered in valuation, cut back its lending business, and is worth less than its revenue. Pandora, our biggest strength is the wealth of data and data science capabilities. We have built our product on
Are they even still around, Pandora?
Data and algorithms with 6 billion stations and 76 million users listening to 5 billion hours of music. We built this amazing product because we have access to data, and it's what fuels a competitive advantage. Pandora has continued to lose money and users year after year.
I think these examples are great because they kind of show you why you should not listen to what I call another thought terminating cliche, which is, well, look at Amazon. Because, you know, a lot of people, when they talk about all their spending on AI and whatever, like one of the things that people tell me to just avoid not having to think about it is you just say, well, Amazon did it. And it's like, we know how many people tried it and failed? Like, Amazon's kind of the exception that proves the rule, but it keeps thriving and it keeps thinking. Because one of the problems is the companies that fail at this, they're not in your face all the time. Amazon is. So it's very easy to just get what they call survivorship bias. You're biased by the very obvious example that survived and is in your face, but all the ones who try to do market dominance through big data, and through that build a competitive moat that no one can touch, and you're just in the top of the world. A lot of places tried it and failed, but they're not on your mind. Like, people don't think about Pandora and stuff like that.
SoFi. We use data and machine learning to iterate and learn, which ultimately leads to innovation. We've built technologies and processes that enable us to iterate and innovate at a much faster pace and a much lower cost, which provides us more access to data and allows us to provide a better service to members. SoFi's valuation has since plummeted as the company's quote-unquote innovation is just selling the same lending products that banks have done for generations, albeit with nicer UI. And Stitch Fix, our whole business model is predicated on this amazing data that we have. Fundamentally, data helps us buy more of the right product and get into more of the right people. We have a personalization engine that gives us the ability to deeply understand clients and products and generate powerful recommendations on what products will be successful and with whom to millions of clients' individualized preferences. We believe our data science insights offer
Also with SoFi is in a real downward spiral right now with the stock price. It wasn't at the time of this video, so they weren't able to give you like a failure story for SoFi, but SoFi is in a really bad place right now. Ironically, they actually had pretty good earnings too, but right now the market is just very negative.
Significant competitive advantage that will grow over time. Stitch Fix today is a penny stock who has laid off thousands of employees, attempted to push even more on its algorithms to cut costs, and still has continued to bleed money and users year after year. And we already know how things turn out for Opendoor, Affirm, Wish, Casper, and DoorDash. It took until the early 2020s for the big data narrative to die out. No consumer startup had demonstrated anything meaningful with big data, and no one was going to wait another 10 years for progress. Yet even as the walls closed in, these startups held on, screaming about machine learning, deep learning, insights, and innovation to anyone still willing to listen.
This is a great video.
In their last breaths. For the sake of what little remained of their stock and reputation, these founders, executives, and VCs could never admit the truth. Yet when the big data hype train was at its peak, between the early 2010s and the early 2020s, Fortune 500 leaders were in crisis mode. Investors were loving FANG and souring on big corporations as dinosaurs trapped in the Stone Age. Walmart, ExxonMobil, Home Depot, Comcast, Disney.
And if you look, this is all a repeatable cycle. Like, everyone's getting skeptical, everyone's souring on it, people are struggling to find narratives. This right now where we are, this is exactly the stage that we're at right now with the AI bubble. Everything being described here, big promises, but people are starting to sour on it, and I think also like people's pocketbooks are hurting or whatever, and they just don't have the money to throw on this stuff anymore. Like, you just YOLO on stocks like before. And VCs are getting kind of fed up too, and whatever.
PepsiCo, Chase, and other big corporations each committed hundreds of millions of dollars, some of them even billions, to build out such technical capabilities for themselves. They were all eager to signal that they could be just as cutting edge as tech startups and publicly flaunted their investments in big data. Yet their adoption was...
Yeah, so this is another thing. Like, not only were the companies specializing in big data, but the old dinosaurs were trying to hop on board too, which is also happening with AI. Like, a lot of big companies are trying to show like they could be one of the cool kids too and have AI.
Fueled by fear rather than merit.
It's hard to imagine an industry that's not substantially altered by this data revolution. Industries as diverse as medical, where the ability to make better diagnostic decisions with the aid of data, or to bring more transparency to issues of cost and quality, can be transformative.
We're definitely a deeply data-driven business. From the data that's coming from our products, our airplanes, and other products, from the data that we use to manage our business. And it's going to be the key difference.
Yeah, and Boeing's been going terrible.
We are on the forefront of a revolution, right? So today, the biggest and most competitive companies in the world will be the one harnessing data. The team that I'm on directly is the team leading that headlight of the organization. So that's something I'm super excited about.
Yeah, so like Walmart, all these things. Although to their credit, I think it's worked better for these companies than for the small ones, because their whole business isn't around the big data. They have a huge business, and the big data just becomes an extra feature that they have. It's not what their business runs on. Which is another reason why I think this whole software crash around AI is going to be ridiculous, because I think what's going to happen is people are going to keep needing the SaaS companies. Like, I think rather than everybody replacing all their enterprise software and SaaS products with Anthropic's AI products and having to run their own server, whatever, what's really going to happen is all the companies like AI, Microsoft, all these things are just going to make their own in-house AI. There's going to be an added feature to the existing product, and they're still going to run your whole software for you remotely and run the server and run the cloud. But now you'll have AI features. I think that's going to be more realistic than all these people just getting rid of all these products and these huge corporations trying to have an internal thing running all this stuff.
Back-end big data analytic capabilities now for a couple of years. And
an internal framework, an internal like system, or server farm, like particular law firm, just having all that server and cloud space being run to carry all the information that they're going to host locally. Like, no thanks.
Data is a huge asset for us. It's surprising to me that more people in our space are talking about it, and especially with us, 2 billion visits a year between our online.
Yeah, so it did hurt big business too. a lot of the big data pivot. This Gap CEO ended up getting ousted over his attempt to try to run Gap like a tech company.
In our stores, using that big data against our best customers, it's a huge asset. And structurally, because we have multiple brands and multi-channels, we've got something not a lot of other apparel companies. Data could help.
Yeah, but it is kind of funny how a lot of these companies in very traditional areas start trying to adopt the big data thing too. Because basically, whenever you said big data, investors are blindly just running to you. And the same thing is happening with AI. Like any company that said AI, it could be a shoe company. You said AI, we're gonna incorporate AI into our shoe design. Like you said AI for anything a couple of years ago, and your stock price will go up. Someone did a study of earnings reports that mentioned AI, no matter what the company was about, and the results, and it would just be ridiculous. As long as you mention AI in your earning report, you can get attention and a pop. And with that kind of irrationality, when the fear comes with it, see, like those people who say, "Hey, it's the algos" or "priced in," they never bring up the algos with that irrational nonsense. You know, like if people are that irrational on the way up, then what type of deep thought do you think they're gonna have when it's time to sell? They're gonna sell for just the stupid reasons.
I'll drill down to see if specific products are leading to infant deaths.
So if we start to see these high mortality rates and we're seeing lots of canned tuna being purchased by these families, then we'll try to look, is there something with the canned tuna that may be helping or causing some of those higher rates in infant mortality?
When the airplane is in flight, we know exactly what they need and we know exactly what part is located. If the next destination do not have the part, then we have to find a way of flying the part coming in. So the key thing is fixing the airplane at the right place, at the right time, with the right part. And if we can do that, then we don't have to worry about airplane grounded.
Hold on, I don't know if you guys saw what was in the corner there, but this guy's doing a good job of, for each promise, this is such exhaustive, good research, very good website. You should definitely check him out. You see all the things that went wrong with Boeing, like the things got better, the things got worse after the big data push.
Then we don't have to worry about airplane grounded.
Unilever is one of the world's largest consumer products goods company. Our products touch 2.5 billion consumers every day with brands like Hellmann's, Ben & Jerry's, and Dove. We're on a journey to become a data insights-driven company. For our employees, that means providing insights for them to make better decisions, help them collaborate.
And you see how things have gone for them.
We develop better products to innovate. And we're finding that instead of looking in the rearview mirror with analytics, people are now being able to predict the future.
The whole raft of initiatives around big data and machine learning that will actually help insurers and brokers to increase the power with which they use their own data. And I see that as being something that is an area that really needs to be improved as an industry. There's more and more data available. Actually, how do you use that, link it all together, join it all up, and turn it into something that's actually actionable in real time?
Data and making that data available, analyzing it, are all ways that we can think about crafting a unique experience for our customers. At JetBlue, we like to say that we're a customer service company that just happens to fly planes. Now it almost seems as though we're also a technology company that happens to fly planes.
No CEO wants to be the one who...
Yeah, now we're a technology that happens to fly planes. Because again, if you forget you think about the technology, you're going to judge us by a different metric. Until that backfires.
Screw the pooch. It was safer to have an iron in the fire than to walk against Silicon Valley. And smaller companies got just as wrapped up in the narrative, with the best example being Under Armour, who dropped over $500 million on fitness apps with a dream of achieving fame margins and uncovering business.
Yeah, Under Armour was even using the big tech thing. But what he said here is very important. But it was safer to look like you were going with the flow than not, especially because if you weren't, and all these things are getting all this buzz and short-term stock valuation going up, if you try to tell your shareholders and whatever at a time when it seems like the future and everyone's going with it, well, I think it's a fad. Yeah, you're just getting fired. Like, even if you're right, it might take too long to be proven right and you get fired. Or God forbid, you end up being wrong and you're going down in history as the idiot who refused to see the future. You become like the person that, turned down the personal computer. I forgot which company it was, but there was some company that was approached with a personal computer first, and they're like, I think it might have been Xerox or something. We're like, no, we're good. Yeah, but anyway.
Insights and user data. It said that during a gold rush, you should sell shovels. For the handful of startups that we've named, there were thousands more of these startups writing the same narrative that never went public. And yet once the corporations joined the big data revolution, the demand for talent skyrocketed. These were greenfield technologies, and it was believed that the more bodies you could throw at complexity, the faster you would arrive at a solution. Job opportunities and salaries for data scientists and software engineers reached record highs as the private sector competed for talent. But this only addressed the problem of who and not how. The majority of consumer startups and big corporations lack the technical means to extract, store, manipulate, analyze, and visualize data.
So these who are going now? Like, let me rewind that. I think it's pretty obvious.
Competed for talent. But this only addressed the problem of who and not how. The majority of consumer startups and big corporations lack the technical means to extract, store, manipulate, analyze, and visualize.
They lack the technical means to handle all this ridiculous data.
Data. And it would take too long to build everything themselves. It would be faster and cheaper to simply buy the tools if they existed.
If they existed. So, yeah, like some places have like that company, I said that 1,900 data scientists going through all this information and forming algorithms or whatever. But that's like a nightmare, and most small places can't do it. So, but also, if even the big places can find a way to do it cheaper, that'll help them too.
This demand spawned a stream of enterprise startups who rushed in to provide ready-to-go, out-of-the-box software tools made for big data. Because thousands of consumer startups had staked their existence on these technologies, and the Fortune 500 were now willing to spend big to catch up.
So thousands of companies stake their future on big data. So you have thousands of companies that have insane amount of data, and few of these companies have the money and scale to just hire enough people to just throw at this data to go through it. And on top of that, even if enough companies did have the money, there's a limit of people. Like, how many people can you get? If thousands of companies have compiled terabytes of data, you know how many experts you need? First off, there'd be a labor shortage for it, and what you'd have to pay them would be incredible. Like, they'd be able to name their price, like these type of scientists. So, like, if you can create a tool, if you hire scientists to create tools that can go through all this data and you sell those tools, that is a much better use of, in theory, that talent's time than trying to get all the talent to directly manipulate the data themselves. So the talent starts getting funneled into the creation of tools to manipulate these thousands upon thousands of terabytes of data, especially because there's a lot of smaller companies that just don't have the money to hire a bunch of people anyway. The demand is there.
Billions of dollars flowed in year after year towards these B2B startups. Unlike the venture capital-backed consumer startups, these corporations had the appetite and the runway to spend 7 to 8 figures in perpetuity on any vendor who could help them get to the promised land. If we revisit the tech IPOs of the past decade, and we look at the companies with the greatest appreciation in valuation since IPO, the winners are nearly all enterprise startups. Datadog and Splunk are two leaders in telemetry that to this day have reached billion-dollar valuations selling table stakes for capturing and monitoring data. Tableau and Apogee both benefited dramatically from the big data trend through the 2010s. Snowflake, Sumo Logic, Hortonworks, and Cloudera are all startups that quickly surpassed hundreds of millions of dollars in revenue selling essentials for big data. And all those petabytes needed to be stored somewhere, which led to storage startups like Rackspace, Backblaze,
Petabytes.
Box, and database startups like MongoDB. The demand for use.
So if you look at these, are all the people selling the shovels in the gold rush. So these aren't the people who are doing big data themselves. These are people selling the tools to do big data. Kind of like how NVIDIA is selling the shovels in the AI revolution. So it's kind of funny. Like, AI was kind of created to be a shovel to help shovel the big data, and it itself became a gold rush. So now you have like something like NVIDIA and other companies that are basically the shovels to help dig out the shovels that'll dig out big data. So we have like shovels digging out shovels, digging out shovels, digging out gold. Like each shovel eventually becomes the new gold that you need a new shovel to help you dig out.
Data meant greater emphasis on SMS and email, which SendGrid, RingCentral, and Twilio were all happy to provide services for a price. The volume of information, sensitivity of data, and complexity of application logic made companies targets for hackers. Security vendors like CrowdStrike, Barracuda, Okta, and Palo Alto Networks have all thrived.
So think of everything that's here, like all the shovels. This person lists a bunch of shovels. This is great, and this is why I love YouTube. Like, CNN should have broken this down years ago. CNN, Bloomberg, all this stuff, they're just adopting these kind of anti-AI narratives, but YouTube has been on it for like a while, and even then I still don't think the mainstream legacy media does as good a job as these things did years ago, and they never credit these people for being ahead of them.
Appetite and the runway to spend 7 to 8 figures in perpetuity on any vendor who could help them get to the promised.
So let's go back.
Revisit the tech IPOs of the past decade, and we look at the companies with the greatest appreciation in valuation since IPO. The winners are nearly all enterprise startups. Datadog and Splunk are two leaders in telemetry that to this day have reached billion-dollar valuations selling table stakes for capturing and monitoring data.
Okay, so that's what they do. That's one set of shovels.
Tableau and Apogee both benefited dramatically from the big data trend through the 2010s.
So they help you visualize the data that you're getting. So that's one set of shovels, like the shovels that help you put your data into visuals.
Snowflake, Sumo Logic, Hortonworks, and Cloudera are all startups that quickly surpassed hundreds of millions.
Okay, they help you analyze the data. So yeah, people just selling people tools for handling these petabytes of data.
Billions of dollars in revenue selling essentials for big data, and all those petabytes needed to be stored somewhere. Which
so now this is where you hold the data in these places. So these end up being the best places to invest during the big data phase. Kind of like how NVIDIA is proving itself to be the best place to invest during the AI phase, like the shovel sellers. But the problem is, if enough gold prospectors go bust, then the shovel store is eventually going to go. Like, the shovel is a more sound investment than the gold prospector. But if enough gold prospectors fail, then the shovel store is going to be in trouble eventually soon, unless the shovel can pivot into a broader base. Kind of like how Levi's started out by being the clothing outfitter to the prospectors, but they became mainstream clothing, jeans, and they were able to survive the death of the gold prospector market.
Led to storage startups like Rackspace, Backblaze, Box, and database startups like MongoDB. The demand for user data meant greater emphasis on SMS and email, which SendGrid, RingCentral, and Twilio were all.
So engagement tools like chat bots, the contact forms, and all that stuff.
All happy to provide services for a price. The volume of information, sensitivity of data, and
now the security for the big data, like to protect your big data, a whole bunch of other companies.
Complexity of application logic made companies target.
So it's a little less sexy than the big data companies, but probably in the long run, the ones who made most of the money. Just kind of like how the people selling supplies to, like the gold prospectors struck gold are by far the sexiest stories of the gold rush, but the more stable, remarkable stories and more consistent stories were the people who sold stuff to the gold prospectors. So the same thing here. Like, people don't really talk about these companies as much when talking about, the big data companies. The other ones discussed were much sexier. People talked about Groupon way more than they talked about CrowdStrike, But anyway.
Hackers. Security vendors like CrowdStrike, Barracuda, Okta, and Palo Alto Networks have all thrived under the promise of helping enterprises and startups secure their data. And to accelerate execution, startups like Atlassian, ServiceNow, JFrog, Asana, and Slack all build themselves as critical tools for boosting worker productivity and collaboration. Being B2B by default doesn't make for a better business.
Someone asked, what is in the big data? Everything you could imagine. That's it. Like you're better off asking what's not in the big data.
As Snowflake and many other tech companies to this day are still chasing profitability, but their valuations are significantly more resilient than those of consumer startups, given the widespread demand, the exceptional deal size.
And I think that's important what you just said. Even a lot of those pick sellers, the people selling the picks and the shovels, they're still chasing profitability too, because at the end of the day, it's just like everything else in tech is chasing stock valuation and growth over whatever, but they're more resilient than the other companies, at least. You know what I mean? So yeah, even though they're better, way better success stories than the gold prospectors, at the end of the day, there's still tech companies selling growth over like consistent profitability.
And the slow churn that's unique to enterprise software. Once a tool or vendor is ingrained at a big company, it's extremely difficult to rip out. Yet not every Fortune 500 had the talent to execute on big data, and most needed to pay an outside firm to perform the implementation. The money flowed not just to tooling, but also to consulting. Accenture, HP, IBM, Oracle, Booz Allen Hamilton, and Gartner all pledged that they had the expertise to pull off any big data project. It's no surprise that these same consultants are now tooting their horns about AI. Yet ultimately, the companies that profited the most from big data were the cloud players. AWS, GCP, and Azure saw their greatest growth during this 10-year period. The consumer startups were spending their funding building their products in the cloud. The Fortune 500s were using big data as a forcing function to adopt cloud in their organizations, and B2B startups were also building their tools in the cloud. To the cloud providers, it doesn't matter if it's big data, machine learning, IoT, augmented reality, or AI. As long as people are using the cloud, and whatever trending technology drives them to use more of it, Amazon, Google, and Microsoft all win. Software engineers have always been in high demand, but the paradigm shifted in this time period with big data. Across the private sector, companies were on the hunt for practitioners, offering the highest salaries to the few available with real-world experience in big data. Since the technology was so new, there were no best practices.
Yeah, so now I need someone to help interpret the big data. So you see like all the things that they kind of are looking for people to be experts in. You can see how it all leads to AI.
Everyone was figuring it out as they went along and doing it all in the open on GitHub. If you're an engineer, you could get experience in big data through your day job or at home through open source. If you knew your way around the most popular tools, you could declare that proficiency on your resume and get rewarded with a higher paying job elsewhere within months. Big data amplified resume-driven software development, where engineers now are incentivized to learn and even evangelize technologies for the sole purpose of maximizing compensation and hireability. Developers today are no longer coding grunts, but instead vocal, visible rock stars who can make demands and spearhead change at their organizations. Engineers get to decide on behalf of their companies what clouds they want to use, what tools they get to adopt, and what vendors they want to partner with. This is why enterprise startups and cloud vendors each spend millions of dollars every year on conventions, free pizza, and beer just to court developers and to try to convert them into champions of their products. This shift to bottoms-up decision-making with engineers leading the way is almost like a battle of religions.
This kind of reminds you of how pharmaceuticals are working now, where you have people trying to spend all this money to court doctors and whatever to become evangelists for their drug, whether it's the best drug for the patient or not. It's a kind of similar thing but except this time the prescription is software for your big data. There was a movie that was about that. I think it was Jake Gyllenhaal and Anne Hathaway, and it was about this guy who worked for a software company running around trying to get them to prescribe his product over other ones. I feel like that's a very apt analogy for this.
Every enterprise startup is trying to convert the most possible developers to their faith at any given time. As a result, software engineering has become progressively more tribal, as developers have hitched their paychecks and career prospects to the popularity of the technologies that they adopt rather than their business contribution.
Because when you think about like getting to those cool kids, building trust and getting them to say, hey, I'm going to bet my company's infrastructure on a product you released 3 months ago that barely works. That's a very high level of trust. And that person needs to have very high conviction that they're not making a career ruining mistake.
And companies keep investing because their technical teams are all incentivized to play up their work, even when there's nothing to show. That's the only way these engineers, their managers, and their VPs can justify budgets, get raises, and climb the ladder. The people that worked on big data had a vested interest in keeping the technology trendy, despite the lack of results, and are now doing the same with AI. Whether it's bottoms up or top-down adoption, money talks, even for those who are simply implementing the technology itself. This is why there's never any end to the online debates between React versus Angular, Kubernetes versus ECS, and so on. You can see that same tribalism in AI, where there's no consensus on what tool is best, TensorFlow or PyTorch, or which model is most accurate. The premise of big data was that you could unearth hidden innovation, business value, customer insights, and market patterns.
I'm sorry, I so hate this type of speak. It's so cult-like, these talking points or whatever. The 4 V's of big data. I don't know why they always do this. Like catchy acronyms, the 4 S's, the 4 V's.
Innovation, business value, customer insights, and market patterns.
Volume, variety, veracity, velocity. It's true sounding, but it's just ridiculous.
From data that was simply too overwhelming for a human to digest and analyze. These days, everyone has seemingly forgotten about big data's failed promises. But the current premise of AI is even more confusing. The new narrative is that data is inherently too complex. Instead, what we're supposed to believe is that all that promised innovation, buried insights, and hidden business value is still in this data. It's just...
Yeah, it's all there. It's just that the problem was you need something to unlock it. And it's AI. So if you can't see, what you do is you keep kicking the can down the road with a new promise. So first it was data, but no, as data and software, but no, that's not enough. The software and data need to have huge amounts of data, not just regular amounts of, not regular big, but stupid big. So now it's big data, but now we need to figure out ways to unlock all this big data. We have a whole we have a whole system built on this now. We can't just take it out of our companies because it's too embedded. There's a whole ecosystem around it of all these different companies that are servicing us. We have a cloud, we have a security network, we have SaaS, like software that runs on this big data. We have all this stuff. So now the AI comes to promise to unlock everything. The thing with each of these promises is that what they do is they don't throw the old thing out. What they promise is, hey, everything that we promise is true. You just need this extra layer to actually deliver on the promise. So just when things are starting to look like people are waking up and it's falling apart, you offer a new nugget that keeps the dream alive. So all this is basically stemming from the original dream of data and software. That's where we are with this AI thing.
that humans can't pull it out. Instead, our only solution is to trust these artificial models, where only a few people have a true understanding of what's really happening under the hood for perspective and insights. We should be told the answers and not seek it ourselves, and we should value the digestibility and presentation above the accuracy of information itself. For big data, every company had its own data, timelines, politics, and priorities, which made execution completely unique. Every implementation was a snowflake deployment. Since no one has achieved any value with big data, no one really knows, even now, nearly a decade later, how to actually implement and derive value. No one can authoritatively say, this is how you execute and this is how you can replicate step for step what we did for your own business. Engineers essentially are reinventing the wheel but never finishing. Managers and executives push for vanity updates and exaggerate their progress for the sake of growing their organizational influence, appeasing higher-ups, and securing their own promotions. The market dynamics that propelled big data are now playing out again with AI, with thousands of new consumer startups arriving on the market with AI products with only the promise of business value. Enterprise vendors who are now peddling AI tools to sell to these consumer startups. The Fortune 500 are running scared once again. The cloud providers and chip makers are laughing from their ivory towers at the money that's raining down from the heavens. Engineers are jumping into the latest open source projects to pad resumes and improve their career prospects. And tech is once again the darling of Wall Street.
Because the changes, the transformation in compute is accelerating at such a pace, and the implications on productivity and efficiency in business are going to be enormous.
Okay, how does he know? David Solomon, Goldman Sachs chairman and CEO. Like, okay, he's the head of Goldman Sachs, so you trust him. But what is his background? He went to Hamilton College. He was a president and chief operating officer, investment banker. Applied to Goldman Sachs for a 2-year analyst position. Then he went to Irving Trust. Went to work for Drexel Burnham as a commercial paper salesman, but transitioned to junk bonds. Joined Bear Stearns, was in a junk bonds division. Then went to leverage finance. Like, basically, what qualifies him to weigh in on this? You see what I'm saying? Like, these people are impressive looking people, but this guy in his life, he didn't have the time to learn the ins and outs of tech. He just looks at what is making money and what story needs to be sold to continue to make money. So that's part of the problem with these people. Like, these people are weighing in on stuff they know nothing about.
Add resumes and improve their career prospects, and tech is once again the darling of Wall Street.
Because the changes, the transformation in compute is accelerating at such a pace, and the implications on productivity and efficiency in business are going to be enormous.
Someone just gave him a report, and he just memorized the report, and he's saying the talking points from the report. If you just ask him how it's supposed to happen, actually like explain how it's supposed to work, he won't know.
What's happened here is we're actually using our Deep Brew AI platform to be able to suggest optimal product pairings based off of contextual information of the store, the weather, and other things that are going on.
AI allows better allocation of resources. Basically, it allows you better planning. You save money, you become more efficient. There's every reason to think that the use of AI will make our businesses more efficient, therefore just literally waste less money. That's good. It's good for economics.
Like Airbnb and Uber, ChatGPT was built on a similar playbook of skirting regulation. ChatGPT went viral for its breadth of knowledge and its convincing human-like prose. But when all of that is built on stolen data, who holds the power? Is it the people who generated the data or the technology that summarized it? Like every other hyped Silicon Valley technology of the past decade, AI is just another cash grab. The primary reason of why OpenAI's employees revolted when Sam Altman was fired was because his removal made their stock worthless, and the staff there are all looking for a payday, just like Sam, the board, and the venture capitalists.
Yep.
It's not a question of whether or not large language models have merit or to dispute that technology improves over time, but based on how little business value was delivered in the past decade from big data, blockchain, SaaS, and every other aforementioned trend, AI deserves much greater scrutiny. Not every innovation can be monetized.
Yeah, you mentioned blockchain as well. So SaaS, blockchain, data, big data, AI, and so forth.
And not every promising technology needs to be a business. Big data did not make any difference for the consumer startups and the Fortune 500 over the past decade. If anything, it only prolonged the lifespan of startups that should have never existed in the first place. These days, all companies are doing layoffs, cutting.
No evidence of impact. Operating margins of data-driven leading Fortune 500 companies.
costs, engaging in shrinkflation, and buying back shares to squeeze profits just like they've always done. Things that they shouldn't have to do if big data actually generated the greater business efficiencies and innovation that was promised. There's nothing in the fundamentals that suggests that big data has netted any meaningful improvements for any company. If there really was business value in big data, someone by now would have something to show for it. The same exact dynamic is now playing out with AI. It's all talk, no show, all hype and no results, all sizzle and no steak, and everyone is falling for the same ruse once again. The only winners from big data were the founders, executives, and venture capitalists of the consumer startup who all liquidated their shares at IPO, or those of the B2B startups. The losers were the public.
Yeah, the B2B startups being those startups that came about to sell solutions to the companies chasing big data.
The investors, and the employees at these companies. If you had to guess, who are the winners and losers of AI really going to be? And what is the value of information without critical thinking, art without authenticity, and creation without originality?
Now, what I think really interesting about that, oh, this is perfect. This is the next thing I wanted to talk about and then load it up. Okay. So at the time the video was created, it was before we got all these narratives against AI. That video was created at the peak buy-in to AI, right? So now, in fact, I bet you if you go to the comments of it,
tech is a sector unlike any other.
I'm kind of curious what the comments were like. I'm sure the comments now are very yeah, so it's interesting. I think that website tends to attract skeptics, so the comments were pretty good. But if a lot of normies at the time found that video, I think it would have been pretty negative. Because I remember at the time that video came out, I would send it to like people I knew who were like all into AI, and this all be like, this is a crackpot, this is YouTube, like shut up. Like they always disparage it because it's YouTube. And that's funny. Every narrative I got on YouTube is now in Forbes, is now in Bloomberg, is now in the New York Times, and it's kind of funny. Like nobody remembers that they started out on places like YouTube and Reddit and stuff like that. Yet there's a lot of people who don't trust anything until it's in the mainstream, but they never learned the lesson that all these mainstream things that eventually got adopted, the mainstream was saying the opposite just a year ago when places like YouTube and whatever were already on board, So anyway, at the time that video was made, a lot of these negative narratives didn't come up yet. And this is why I think is very important. Every time people start getting disillusioned, people take the disillusionment and the objections that are coming up and they create a new solution that promises to fix the problem. So it's like when people were saying, hey, big data is not working, these big predictions and unlocked values not happening, then they're able to point out all these solutions they had with big data. Like the problem is we need more of it, not that the premise is wrong. So here's a solution. Everyone bought into it. And then when that didn't work, then it became, hey, we have these tools that help you unlock all the information. No human can unlock it. And then that's AI. So now what are the objections by AI? It's the cost of compute, the CapEx spending is too expensive, too much, it needs too many resources. The data centers require too much power and whatever. And as far as I can tell, they haven't found a way. Like, how can you create more natural resources? I think it's a very tough one. Like how are you gonna make water and electricity and real estate that you need to put these things on? They're like finite resources and they're expensive. How are you going to fix that? And I think one thing they were trying to do was make the promise of quantum computing, but I think that was too much of a reach. You try to say, hey, all this compute power, quantum computing is gonna fix it because quantum computing needs like a fraction of the compute power and it can do amazing things. So you remember when they were trying to launch all that quantum computing talk? And Jensen Huang fucked up by being too honest. Jensen Huang was like, yeah, that shit is way down the line. That's not happening anytime soon. And all the quantum computing stocks fell. And I think Jensen Huang kind of realized how he fucked up because he kind of, I think he realized, damn, we need quantum computing to be bought into to get the AI hype train alive, because quantum computing is going to be what AI was to big data and what big data was to data, which is it's going to be our promise for why the next set of objections isn't really important, you know? So then suddenly Justin Wong tried to walk it back and started having quantum computing day and tried to talk up quantum computing, but I don't think the magic ever came back. Like, I can't figure out what narrative they can come up with. I'm not saying it's impossible. It might be possible. But I think the other problem is they don't really have a charismatic salesperson to really, like, I think people are waking up to Elon Musk as a snake oil salesman. I think Sam Altman is just too creepy. I think people kind of feel his creepiness. When OpenAI first came out, I think people kind of started wanting to form a cult around him. But I just think that he just came off too creepy and weird. And then now this new guy, Dario, whatever his name is, from Anthropic, suddenly he's everywhere, giving long interviews, making incredible claims. But I think he's going to become off creepy too. And I think he is doing a lot of dumb things. I don't think he's going to be the guy, the personality that's going to sell a saving narrative. So I'm not saying it's impossible. I mean, something might come around to salvage the reputation of AI the same way something came along to salvage big data and data, all this stuff. But we'll see. But this is a newer video that came out like just last week, and it's called the AI job loss hoax. And this is a video by Wall Street Millennial, and it came out in the current climate of more normalized AI and widespread AI skepticism.
Ever since the release of ChatGPT, AI executives in the news media have been hyperventilating about how AI will take everybody's jobs and thus cause mass unemployment. We are now in the 4th year of the AI bubble, and there's very little evidence that AI is displacing a significant number of jobs. According to the consulting firm Challenger, AI was responsible for 55,000 layoffs in the US in 2025.
And one thing is, the AI people, they like spreading these crazy narratives because these crazy narratives help them sell AI. You know what I mean? So, when they say, "Oh man, AI is gonna destroy the world," you know, when people hear that, they're like, "Oh man, in that case, I better invest in AI." Like, it makes people foam at the mouth. Like, a lot of the big shots who are involved in tech, they hear like all these claims and they think, "Oh man, if this thing is powerful enough to destroy," like, people would think, "Hey, why would AI leaders talk about how destructive their stuff is if it's not true?" Like, that's bad press. But you're thinking like a normal person. To the kind of lizard people that run corporations, hearing that these tools have the power to destroy the world actually makes me think, hey, I need to have them before my enemies have them or my competitors. Like, they salivate at the idea that these things are going to destroy industries, that are going to drive people to poverty, are going to become machines of war that can cause a nuclear strike. Like, they don't think like you and I. And these heads of AI companies know that, and they want to sell these outrageous doomsday scenarios. So whether it's outrageous claims about industries going to disrupt or about real world harm is going to do when nuclear strikes, you know, because I think you know what? I'll hold that point for later. Let's keep going.
Well, that sounds like a lot. We need to put that number into context. In 2025, there were over 1 million layoffs, so AI was only responsible for 5% of total job losses. For those 55,000 layoffs, that just means the company said the layoffs were due to AI. There's no way to confirm that the jobs were actually replaced by AI.
Yes, yeah, I think that's something that's important to say too. It makes them look better to say that AI is driving these job losses because, look, if that's true, then what you're investing in sounds worthwhile. You know, and what you're spending CapEx on sounds worthwhile.
In many cases, a company needs to conduct layoffs for other reasons. For example, if they overhired in the past, instead of admitting the real reason, they'll often credit the layoffs to AI because this sounds better to stock market analysts. In the few cases where companies have actually tried to replace employees with AI, the results have often been poor. A recent study in the UK found that 55% of companies who replaced workers with AI now regret the decision, and in many cases are hiring them back.
I'd be so pissed to be called back by a company that fired me because of AI. Like, how safe do you feel once you return? I always wonder about that.
Of course, different jobs will have different impacts from AI. One of the jobs believed to be most at risk is software engineering. On paper, software engineering should be one of the easiest jobs for AI to replace. LLMs are trained by scraping huge amounts of data from websites like Stack Overflow. Anthropic's Claude Code and OpenAI's Codex can output huge amounts of code very quickly. In January of 2026, Anthropic CEO Dario Amodei made the following prediction.
I have engineers within Anthropic who say, I don't write any code anymore. I just let the model write the code. I edit it. I do the things around it. I think, I don't know, we might be 6 to 12 months away from when the model is doing most, maybe all of what SWEs do end to end. And then it's a question of how fast does that loop close?
According to Amodei, within 6 to 12 months, AI will be able to do everything that software engineers do end to end. That might sound scary to aspiring software engineers. In fact, many universities have reported a decrease in computer science majors, as students are scared that software engineering jobs will all be replaced by AI. The only problem is Dario Amodei made the exact same prediction almost 12 months ago. In March of 2025...
Yeah, this guy is like Elon Musk, and Elon Musk always makes promises, and then the so-called experts just breathlessly repeat them and just ignore the fact that he made the same promise for 8 years straight and hasn't delivered on a single promise for over a decade. That's what I'm saying. This Dario guy from Anthropic, who's showing himself everywhere, I think he's going to be a terrible face for AI, because he's doing two things that I think are crazy. He's making a lot of ridiculous claims that are killing software companies unjustifiably. These promises that, all these things Anthropic can do are going to replace all these software companies. So he's killing all that stuff, but he's also taking aim at his competitors. He's bashing the other AI companies, which I think is short-sighted. I think right now the AI companies need to hype each other up and almost operate as like a cartel. Like, the AI narrative is too flimsy for them to take shots at each other. Like, when they're strong enough, when they've confidently won and they've also got the next scam set up, then they can start fighting each other for who's going to win. But right now, Anthropic did this commercial bashing the AI of other companies, and I'm like, people are so AI skeptical right now. You don't want to add to the fuel to the fire of making AI laughing stock. I know you're trying to do it at the expense of your company, trying to say your company is the best, but I think it's short-sighted. I think right now AI as a technology needs all the boosterism it can get. So this guy is killing software, but I think he's also he's causing a lot of fear and narratives. And I also think right now they need a lot of buy-in from AI from the normal person, like venture capitalists, big investors, smart money, investment banks. They love hearing, oh, this is going to kill whole industries. This is going to replace a bunch of people, because their jobs are safe. The regular Joe that you need to buy in as a customer of this stuff, or that you need to buy in as a retail investor, I think is not going to find it as palatable. They're not going to want to buy a stock that seems like that evil and that its success might help ruin them, and they might not want to be a regular customer of such a thing. I think this guy is kind of autistic, and he doesn't really understand people, and he's not going to be good. I think it's that the Elon Musk problem.
Amodei made the following prediction.
But now getting to kind of the job side of this, I do have a fair amount of concern about this. On one hand, I think comparative advantage is a very powerful tool. If I look at coding, programming, which is one area where AI is making the most progress, what we are finding is we are not far from a world, I think we'll be there in 3 to 6 months, where AI is writing 90% of the code. And then in 12 months, we may be in a world where AI is writing essentially all of the code.
Yeah, so 12 months, that's like a month from now. So based on this prediction from last year, March 2025, we're reaching 12 months right now. AI is supposed to be writing 100% of code, but all the people breathlessly reporting his latest predictions ignore these predictions made last year that were total bullshit.
That was in March of 2025. In 3 to 6 months, AI will write 90% of all code. In 12 months, which is basically now, AI will write essentially all of the code. Of course, this hasn't happened. Basically, since the release of ChatGPT, tech CEOs have been saying that AI is going to take everybody's jobs within 12 months. 12 months later, AI hasn't taken any jobs. But then they make the exact same prediction delayed by another 12 months. In this video, we'll explain why AI is not replacing a significant number of jobs and is not likely to do so in the foreseeable future. And more importantly, we'll look at why AI CEOs want you to believe that AI will take your job, even when it won't. Let's start off by looking at software engineering in particular. It is true that many software engineers use AI tools. According to Google, 90% of technology workers now use some form of LLM during their work. This may very well be true, but just because software engineers use AI doesn't mean they can be replaced by AI. So how do coders actually use AI? Let's say you're a software engineer. Even if you're very experienced and capable, you will forget certain functions from time to time. Back in the day, you would go on Stack Overflow. You'd find examples of the function you're looking for and copy-paste that into your own code. AI models are trained by scraping the internet. They can pretty easily recreate everything you would read on Stack Overflow because they were trained on this data. Now, instead of going to Stack Overflow, you can go to ChatGPT to look up functions. This is much easier. You can even use an AI native IDE like Cursor or Codex to have the AI write whatever function.
And it's the kind of stuff you need experts to tell you, which a lot of these, like the Anderson Coopers of the world, they don't really understand this. And it's like the news cycle moves too fast and it's too nonstop and too flooded for people to take the time to do this stuff. You have to keep moving on from hot topic to hot topic. Only like real thorough weirdos, like the people who, and when I say weirdo, I'm not saying it disparagingly. I'm saying that the normal way of doing things is so bad now that being thorough and caring about getting the facts makes you weird now. So I'm saying weirdo in scare quotes, like weirdo as in the crazy world, this is what a weirdo is now. Somebody who actually double checks things and thoroughly like goes through things with experts. Like Anderson Cooper has like 100 things to talk about a week. He's not really, and his researchers are just looking for whatever is salacious and is in easily digestible. This is not, fun CNN watching.
Directly in your code, so you don't need to copy paste. Using AI can save you a little bit of time compared to using Stack Overflow. Most AI coding tools are pretty cheap compared to the salary of a software engineer, so it makes sense that these tools have been widely adopted. If you see a statistic that 90% of software engineers use AI, this can give a highly misleading impression of how useful the AI actually is. A software engineer does much more than just memorize a bunch of functions from Stack Overflow. In real-world environments, engineers must collaborate closely with product managers, designers, security teams, and other developers to define requirements and make thoughtful trade-offs. They spend significant time debugging issues, maintaining and refactoring existing systems, reviewing code, writing tests, and ensuring reliability and performance at scale. You can try to use AI to create an entire piece of software or even an app. This is called vibe coding. The idea is that someone with limited or no coding experience can create a new app just by giving the AI natural language prompts. But there are huge problems with this approach. There are very few examples of software or apps that are created with AI alone. The highest.
I've tried vibe coding and it's fucking terrible. Like it does a big amount of stuff in the beginning that makes you feel like, oh shit, I just did 80% of an app. Like it'll deliver you something. And then that final 10 to 20% that you need to get it like perfect, you'll spend hours, days, weeks trying to get that right. And it'll just keep fucking everything up and making things worse. And the longer you go in the workflow with it, it doesn't have like object constancy. Like it's not able to keep all the data it's forming in a conversation throughout the whole conversation. I notice it forgets the earlier part of the conversation and you start re-explaining old stuff, or it forgets old stuff. You don't realize it forgot old stuff. And then you realize that it's on a whole new project now. Like actually the app is trying to make for you, or software it makes, actually degrades the longer it takes to get it fixed. I find. I tried this about a year ago. I don't know how much they've improved it, but I just found like it's easy to spend a lot of time trying to fix what seems like a shortcut,
Profile example I could find was Moltbook. Moltbook is a recently released social media platform. It has a very basic interface, similar in some ways to 4chan. It's supposed to be a social media platform for AI agents. The idea is you create an AI agent with ChatGPT or Claude and give it access to Moltbook. People's AIs will talk to each other on Moltbook and have completely fake AI conversations. There is zero practical use case for Moltbook. It's basically just an AI gimmick. The creator of Moltbook is a guy called Matt Schlicht. He claims to have used AI to create the Moltbook website. He didn't write a single line of code by hand. Within days, hackers found vulnerabilities in Moltbook's code, which they were able to exploit. Hackers were able to steal 35,000 email addresses and 1.5 million OpenAI and Anthropic API keys.
Wow.
These were the API keys people use to power their AI agents. If your API keys are stolen, the hacker can use it to rack up huge bills that will be charged to your account. So yes, you can vibe code an entire app or website, but it will have so many security holes and other problems that no real company will be willing to put their name behind it.
And this is the reason why I was saying this whole SaaS apocalypse is like crazy. This idea that you can just replace Workday, ServiceNow, Adobe, all these companies, with just an AI thing, because then these companies do more than just give you something that spits out a result. They manage the security on the thing. They manage the upkeep, the cloud, the whatever. So you see this thing this guy's created with AI, and it was full of vulnerabilities that people were able to jump in right away and start exploiting. So, like, I would tell people consider buying the software companies that dipped, but I would also warn against it because even though what I said makes sense, you're not ruled by the objective reality. You're ruled by how stupid everyone else is. So, sure, based on what I said, it's clear that AI is not driving software out of business, but investors might stay stupid about that for like the next year. You might buy one of these stocks hoping that, oh, this thing dipped, I'm going to buy it because Trevor told me all the reasons why this stuff is never going to replace AI. But I mean, how long is it going to take for the regular person to get that? I mean, what I told you, as much sense as it makes, how many financial news people have you heard break it down like I just told you? The amount of people just blindly reporting this SaaS apocalypse, the software company apocalypse is going to happen without any meaningful pushback is huge. Like I would tell you to wait until you start seeing the narrative that actually this is stupid pick up in the mainstream. Like, for example, I was aware of all these narratives about circular accounting, depreciation expense fuckery with the earnings reports, and computing needs and data center problems and capex stuff for like over a year, based on the kind of research I've been doing. But I kept investing in AI and these companies and tech for that whole year because as long as I kept seeing them in the regular newspapers and narratives and message boards and Twitter, a bunch of dummies just calling everyone who said this a crank, I was like, I'm just gonna retard max and just be like everyone else. And I started getting out of everything like about 4 or 5 months ago when I started seeing these things going mainstream and podcasts talking about it and whatever. So that's kind of the trick about being smart and right too early is the same as being wrong in investing. But anyway, let's go on.
Security is a huge problem with vibe coding. The cybersecurity firm Apiro has witnessed a massive increase in security breaches over the past year. They attribute this to software engineers increasingly relying on AI tools to write code. AI coding tools cannot fully replace software engineers, but maybe they can increase the productivity of each software engineer, so you need fewer of them in total. While this sounds like a reasonable hypothesis, it is not borne out by the data. Many software engineers think that AI increases their productivity. The AI spits out a lot of code very fast, so it feels like you're working faster. But in reality, the code has so many problems in it that you spend more time fixing the problems than it would take to just write the code by hand.
Yeah, and that was a problem I had when I tried vibe coding.
2025, a nonprofit organization called Model Evaluation and Threat Research, or METR, ran an experiment to see how effective AI coding tools are. They hired 16 software engineers to complete various coding tasks. The software engineers had about 5 years of experience. Half of them were allowed to use AI coding tools, while the other half were not. The coding tool was Cursor Pro using Claude 3.7 Sonnet, which was considered to be the best coding LLM at the time. The results were shocking. Before completing the task, they asked the software engineers to estimate how long it would take. The ones who were not allowed to use AI thought it would take 2 hours to complete the task. The ones who were allowed to use AI thought it would only take them an hour and a half. In reality, the software engineers who were not allowed to use AI were able to complete the tasks in about 1 hour and 40 minutes, less than they forecasted. The ones who used AI took well over 2 hours. While software engineers think AI speeds them up, it actually slows them down. Over the past few years, the media hype around AI job losses has reached a point of near absurdity. Let's watch a clip of Anthropic CEO Dario Amodei speaking to CNN in May of 2025.
And this guy gave a recent 2-hour plus interview on YouTube. I was thinking of chopping it up to like the key points and showing how ridiculous it is. But this thing is going rampant with people who just don't know better. People who just run with narratives. But I tried like watching it. It was too much. I couldn't take it. Like even as a public service to you guys, I found it very tough to sit through his ridiculousness.
Dario, you said that AI could wipe out half of all entry-level white-collar jobs and spike unemployment to 10 to 20%. How soon might that happen?
Well, let's well, first of all, thanks for having me on the show. But just to back up a little bit, I've been building AI for over a decade, And I think maybe the most salient feature of the technology and what is driving all of this is how fast the technology is getting better. A couple of years ago, you could say that AI models were maybe as good as a smart high school student. I would say that now they're as good as a smart college student and sort of reaching past that. I really worry, particularly at the entry level, that the AI models are very much at the center of what an entry level human worker would do. And so it's hard to estimate, exactly what the impact would be. And there's always this question of adaptation. And these technology changes have happened before, but I think what is striking to me about this AI boom is that it's bigger and it's broader and it's moving faster than anything has before. And so compared to previous technology changes, I'm a little bit more worried about the labor impact simply because it's happening so fast that yes, people will adapt.
And you've seen like the crazy claims people were making during the whole big data phase. Like it's the same thing over and over again, just crazy promises.
But they may not adapt.
Because they're going to do an IPO soon, Anthropic. That's why you're suddenly seeing this guy everywhere and the commercials on the Super Bowl and stuff. They're trying to push this IPO that's going to happen. That's already crazily overvalued. And he's trying to present himself as the good alternative and the only smart business alternative to the other companies. So he's also bashing the other AI companies' business models in these press tours that he's doing to promote him as the more responsible business model, even though he's ridiculously overvalued too. But he's using the worst capex spending and the worst overvaluing of the other ones. But I think it's going to be a big mistake because I think they're all going to rise or fall together
fast enough, and so there may be an adjustment period.
You are running an incredibly important company in AI, and you know this better than anybody, or as well as all the names we know, people, Sam Altman and others who are working, Elon Musk in AI. Why are you raising the alarm? Because it's not necessarily, I would think, in your best interest. Because a lot of the messages we hear from, at least publicly, from some AI CEOs and stuff, is a little bit more calming. Like these agents are going to be great in your life, and yes, there may be problems, but writ large, this is a fantastic thing.
Yeah, I mean, I think the reason I'm raising the alarm is that I think others haven't as much, and I think someone needs to say it.
Dario Amodei did something very clever here, and he completely fooled the CNN anchor. Anthropic is developing AI. Amodei is sounding the alarm about the negative impacts AI will have on the job market. Supposedly, it will cause the unemployment rate to increase to 20% within the next 5 years. Amodei seems credible because he is sounding the alarm about AI, despite being the CEO of an AI company. His alarmist statements seem to be motivated by a genuine concern about the people who will lose their jobs. While I can't get inside Amodei's head, I believe his motivations to be very different. Anthropic mostly sells its Claude chatbot and Claude Code product to enterprise customers. For a company to spend large amounts of money on Claude Code, they need to believe that this technology will allow them to lay off software engineers. That's the only way to justify the spending. For Anthropic to sell its products, it needs people to believe that AI can replace human workers. But
yeah, and I just get kind of annoyed that like CNN doesn't have people to really. They're always playing catch up. Like in maybe a year or two, they will start pinning people like him to the wall about this stuff. The same way they're pinning these people to the wall about circular accounting and a lot of bullshit claims when they were just blindly accepting their bullshit just a year ago. But then it might be too late.
As we'll see shortly, there's very little evidence that AI can replace human workers. In fact, there's a lot of evidence to the contrary. One of the problems with reporting about AI is that public company CEOs often exaggerate how much their companies are using AI because they think this sounds good to Wall Street analysts. For example, in June of 2025, Salesforce CEO Mark Benioff claimed that AI is doing 30 to 50% of all internal work within Salesforce. If this were really the case, they should lay off 30 to 50% of their employees and recognize huge cost savings. Of course, this hasn't happened. In September, it was reported that Salesforce laid off 4,000 customer support workers. Salesforce has over 70,000 employees, so this is only about 3%. It was later revealed that Salesforce didn't even lay off 4,000 people. They reassigned 4,000 customer support workers to other roles, but there were no net layoffs. They tried to get AI to do customer service, but this has caused huge problems with faulty responses. A Salesforce executive told The Information that the company has lost confidence in LLMs over the past year due to poor performance at customer service tasks. Mark Benioff made huge claims about AI, which generated a lot of media headlines, but there's really no evidence that Salesforce is getting any efficiency gains from AI. Another example is Microsoft. If any company can replace workers with AI, it should be Microsoft. Microsoft owns 27% of OpenAI and uses OpenAI's technology to create its own AI coding tools, such as GitHub Copilot. Microsoft requires its employees to use AI. AI usage is tied to performance reviews. If you don't use AI enough, you'll have your bonus cut, or you might even be fired. In May of 2025, Microsoft CEO Satya Nadella boasted that 20 to 30% of code at Microsoft is now written by AI.
Yeah, but it's crazy because if you're forcing people to use the AI, then I should even telling you the truth. They might be pretending to use it or just going through the motions of using it. It's a self-fulfilling prophecy. But they also need to justify all their capex spending and investment in AI by showing that their people use it.
The The shift to AI coding has coincided with huge problems with Windows 11, which is plagued by bugs and security issues. Despite bold claims about AI replacing humans, Microsoft's number of full-time employees has continued to increase. Perhaps the most egregious case of AI hype comes from BlackRock, which is the world's largest asset management company. BlackRock is a major investor in AI infrastructure. In 2024, they created a new subsidiary called the BlackRock AI Partnership, which invests tens of billions of dollars into AI data centers. BlackRock CEO Larry Fink is a huge proponent of AI and claims that his company is deploying AI internally to improve efficiency. In January of 2026, Fink spoke at the World Economic Forum, where he boasted about the revolutionary impact of AI.
With your data, I could just tell you from at our firm, things that would take 12 hours to compute now takes minutes. For us, processing $14 trillion of other people's money with hundreds of thousands of different mandates, we can do that instantaneous. And that, to me, if it wasn't for the technology and AI, today, we would not be able to function to the scale that we're operating.
BlackRock manages $14 trillion of client assets. BlackRock's operations are so complicated that it's not possible to manage without AI. Without AI, BlackRock could not function at its current scale. There are a few problems with Fink's narrative. Generative AI only became widely available after ChatGPT was released in 2022. Before then, BlackRock was not using generative AI to any significant degree. Back in 2021, BlackRock already had $10 trillion of assets under management. That's within the same order of magnitude of what they manage now. They were able to function just fine in 2021 without AI. Even after BlackRock started implementing AI, they continued to hire more employees. Again, no sign of any AI-driven job losses. When you use LLMs, they can feel like they're very capable. They feel like maybe they should be able to replace at least some human workers. But when left on its own, AI is surprisingly incompetent. In October of 2025, an organization called the Center for AI Safety published a study called Remote Labor Index, measuring AI automation of remote work. The study was funded by Scale AI. One of the co-authors is Alexander Wang, who is a co-founder of Scale AI and is currently the chief AI officer of Meta. They went on to freelancing platforms such as Upwork and Fiverr. They found freelancing jobs that in theory an AI should be able to complete. For example, build a web page for data visualization, create a 3D rendering of a product, or animate a short video. The average cost for these freelancing jobs was $632. They tested many different AI models to complete these freelancing tasks. The results were atrocious. The best performing AI agent was Manus. Manus creates AI agents powered by multiple frontier LLMs. Even it only had a 2.5% success rate. They gave Manus hundreds of freelancing tasks. Only 2.5% of the time did it complete the job acceptably. Success is defined as creating an output that a reasonable buyer on Upwork or Fiverr would accept. All the other LLMs did even worse. In 18% of cases, the AI agent delivered corrupted files, meaning you couldn't even open the file. In 36% of cases, the project was incomplete. In 46% of cases, the project was completed, but the quality was so bad that a reasonable buyer would not accept delivery of it. In 15% of cases, there were inconsistencies. That means the AI did create a usable output, but it's different from what you asked for. In less than 2% of the cases did the AI complete the job successfully. The Center for AI Safety maintains a website called remotelabor.ai. Every time a new AI model is released, they conduct the test with the new model. Subsequent to them releasing their original report, OpenAI and Anthropic have both released new models. As of the time of recording this video, the best performing model is Claude Opus 4.5. It has a success rate of 3.75%. This study was funded by Scale AI. Scale AI is a company that sells training data to LLM developers. They have every incentive to exaggerate the capabilities of AI. I give a lot of credit to Scale AI and Alexander Wang for having the integrity to publish this research, which exposes the limitations of current AI technology.
Yeah, I have to admit, this guy, he really, I am impressed that he does stay honest with the research, but he's one of the few. Most of the people are incentivized to lie and do lie.
Dario Amodei goes on TV and tries to scaremonger, saying that 50% of entry-level jobs will be replaced by AI within 1 to 5 years. In reality, his best model can't even complete 4% of freelancing gigs. If you can't even do a Fiverr gig, you definitely can't do a full-time job. To finish off this video...
Yeah, this is fucking ridiculous. If you want to see how bad the mainstream financial media and legacy media is at pushing back or understanding anything, like, the problem is, like, they need to find some kind of scientists, honest scientists, who also are able to be journalists. Like, something has to be done because they really suck at this. At least people are just willing to actually sit down and really do the research, but not everyone's rushing to just be on something. So I think all they want to do is rush and have this guy on as soon as possible after he wrote this, because, you know, things get old within like a couple of hours or a couple of days. It's already old news. But this thing made the rounds last week. Something big is happening, and it went very viral. And it was pure AI hype nonsense.
We need to debunk one of the most outrageous recent cases of AI scaremongering. On February 10th, 2026, a guy called Matt Schumer made a lengthy post on Twitter titled, "Something Big is Happening." In the essay, he claims that AI has reached an inflection point and will imminently take everybody's jobs. Schumer's post went viral, getting over 80 million views on Twitter. It was quickly picked up by the mainstream media. The entire essay was republished in Fortune magazine. Schumer was invited to give interviews on mainstream news outlets, including CNN and The Information. Once we look at Schumer's resume, you'll see why it's outrageous that this man is given any airtime at all. Matt Schumer is the founder and CEO of an AI startup called HyperWrite. It is an AI-based text editor. It is powered by a version of Meta's Llama open source model. In September of 2024, Schumer claimed to have created his own open source LLM called Reflection 70B. He started with Meta's open source Llama 3.1 model. He used an advanced technique called reflection tuning, which enables LLMs to fix themselves. This drastically improved his capabilities. Schumer claimed to have tested his new LLM on various benchmarks. On all the benchmarks, it performed better than ChatGPT. On most of the benchmarks, it performed better than Claude. If true, this would be a great achievement. OpenAI and Anthropic spent billions of dollars to develop their frontier AI models. Matt Schumer, with a tiny fraction of that budget, created a new open source LLM that performs even better. There's only one problem. It was all fake. Schumer made Reflection 70B open source so anybody could test it. People soon found out that was actually just a wrapper that used Claude's API on the back end.
But meanwhile, he went viral and made it on CNN and CNBC and all these other places.
Now put as Claude Sonnet 3.5. Schumer set up Reflection 70B so that it wasn't allowed to say the word Claude. He didn't want the LLM to call itself Claude. If you asked it to say the word Claude, it is programmed to only return blank text. Matt Schumer lied to the public. He said he created a groundbreaking LLM, when in reality, he created nothing.
It's crazy. He created this bullshit thing, then made this big article with all this scaremongering about, AI, and then everyone just legitimated it. And like, who knows what kind of market problems, get caused by people listening to this crap and selling stocks accordingly, But I think that's kind of the narrative hope now for AI. What they're hoping to do is scare everybody into thinking that this is so powerful you have to invest in it. But I think it's backfiring because this is what I think is going to happen. At least all the other things like big data, AI, etc., they were extending what came before them and amplifying them. So now, being into data, software, big data, and all that stuff, it gets helped by the narrative that AI is coming to make all of it easier. But now that AI is having this problem now where people like Dario and this guy are trying to create value in AI by telling you it's going to kill everything. It's going to kill all the software. It's going to kill all the workers. It's going to kill all the coders. Instead of amplifying and extending all the cult-like movements that came before it. But people still don't buy that AI can support itself. They don't buy that the capital expenditure. So it's kind of like a kamikaze. It's become a kamikaze technology. It's become this thing where it's going to kill everyone else, but it's not going to kill it so that it can live. It's going to kill it and kill itself at the same time, which I think is like the worst case scenario. I think what these people are doing is going to accelerate the idea of a crash. Like, what they need to do is sell more of a positive story about AI than a scary story, because the scary story worked when people thought that everything that AI killed was just going to make AI itself more profitable. But if people think AI is both killing everything, but that it's not ready for prime time and profitability itself, that's where we are now, where all the companies that people claim AI is going to kill are going down the toilet in stock price. But the AI companies themselves aren't benefiting from their decline. They're declining alongside them.
To use the Claude API. He went through great lengths to hide this, but he was exposed nonetheless. The fact that the mainstream media takes this guy seriously is a testament to how gullible they are.
Yes.
You can read Matt Schumer's viral essay if you want. It's on his Twitter account, but it's extremely long and mostly not worth reading. 90% of it is hyperbolic assertions with zero citations or evidence. There's only one part where he makes specific claims. He says he started using ChatGPT 5.3 Code X. That's OpenAI's latest coding LLM. He says he made an app with Code X. The app can even open itself and click buttons. Schumer does not explain what this app does. He does not provide any evidence that this app even exists.
Yep.
We're just supposed to take his word for it. All right, guys, that wraps it up for this.
Yeah, terrible thing by the mainstream media. And if you look, freaking CNN, who's supposed to be the investing experts or people that people trust, they had him on, and took him seriously, and I'm not gonna play it because I think it'll kill the copyright claims. I think it'll cause a problem. But yeah, they gave him legitimacy. They just had him on with no pushback. They just recited his claims verbatim. The kid, he's like a literal kid, just trying to create hype. Anyway, last video. It's gonna be short. The video itself is long, but we're running a couple minutes of it. But this guy is one of the first people I saw who was spreading all these fact-checking narratives on AI. It's called Nobody Special Finance, and he was one talking about circular accounting, um, funny accounting practices on the earning reports, and improbable expense and all this fuckery with AI. He talked about it years ago. He gets no credit. Nobody talks about him, or credits him with being one of the first people to start the circular accounting narrative. And he jokes about it all the time. How he went from being mocked on Twitter to now everything he said was a common talking point now, but no one credits him, whether it's Forbes, Bloomberg, New York Times, or anything. When they really should have been the ones running with it from the beginning. But anyway, he describes this is called shady AI accounting finally getting the scrutiny it deserves. And he talks about how all the usual stuff that AI was doing in its self-promotion, suddenly the sentiment is so bad now, which is what every technology has gone through that we described, from the the software, the data, the big data, etc. They reach this point where they start getting questioned, and people are like, okay, enough's enough. Start showing us results, or start showing us that this thing works, or whatever, or that this thing delivers results and profits. But unlike the other times, I don't think they have anything on deck to handle these objections. But he's going to talk about, in the first couple of minutes, examples of all the things that people suddenly care about now.
All right. Good morning, everybody.
He does a morning show every day, but before the markets open.
Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today is February 12th, 2026. And our top story this morning, I'm just so delighted to see this finally making news. I'm sitting here like, where the hell have you guys been this whole time? The shady accounting practices and artificial intelligence, in particular by some of the big hyperscalers and big tech, are finally getting at least a trifle sum of scrutiny, which feels like, a significant yet, or insignificant yet symbolic gesture to me. Ernst & Young, in particular yesterday, Meta's auditor, Ernst & Young, one of the big four accounting firms, they flagged the off-balance sheet accounting, in particular, that $27 billion deal that they cut with Blue Owl Capital, where Blue Owl and Meta create this joint venture. Blue Owl goes out and borrows billions of dollars to pay for this data center construction that Meta is going to run, and they're going to operate it and make all the decisions. Basically, all of the debt that Meta is taking out to pay for this data center will not show up on their books, will not show up on their quarterly earnings. And that's basically off balance sheet. That's known as a special purpose vehicle. And that is freaking exactly what Enron did. They called them Raptors, special purpose entities, SPEs, whatever you want to call them. All these funny names for it. They hid their debt from public scrutiny. And I remember when this was announced months ago, and I'm sitting here screaming from the top of my lungs on this channel, like,
yeah, so he was talking about this months ago, like, what the hell are they doing?
Look what they're doing. It's Enron, except Enron at least pretended to try to hide it. They're doing it out in the open, like, look how awesome my fraud is. And I've been sitting here the whole time like, I feel like I'm taking crazy pills. And finally, some of the auditors are flagging it. And I mean, it's like, hey, great, welcome to the...
I think the reason that they're flagging it is, like, why weren't they flagging it before? And I think because the climate was different. I think it kind of shows that we're in a different space now as far as people's sentiment toward this stuff. So it's like, the auditors are like, okay, people are looking at this stuff with more scrutiny now. I don't want to go down with the ship or take a hit for these guys. Whereas before, the mania was so crazy, maybe Ernst & Young would have let it go just because they would have known that the climate was what it was. I think it's a good indicator of where we are in the climate right now.
The party, pal. I'm glad you guys are here. I'm glad auditors are finally out there doing auditor shit. But what took you so long? They flagged this as a critical audit matter. And a critical audit matter is like, basically they raise a red flag in their reports and they say, guys, this one thing that the company did, this is really, really bad here. This is, we're not so sure if it's the right thing or not. It required a lot of opinion, a lot of subjective analysis, and we're just putting a giant asterisk next to it to let you know that we're not really sure. And this is very unusual to see something like this in a big tech accounting matter. So, hey, look, great. That's finally going on. XAI is doing the same thing. We just talked about that earlier this week, that they're setting up special purpose vehicles to take out data center loans because the hyperscalers have burned through some of the most tremendous cash flow the world has ever seen. I mean, these companies are immensely profitable and they are wiping out their cash flow to pay for this silly science project. And now they're taking on tens of billions of dollars of debt on top of that. And again, that debt, where is it ultimately going to reside? It's going to reside in your pension, in your 401k. Now, even as this is all going on, we got an article in the Wall Street Journal this morning. Big tech's accounting creates a blind spot in the AI boom. Now, this
Yeah, so Wall Street Journal is talking about this accounting, but this accounting is not new, but they're talking about it now because I think everyone is looking now, and now these places, just like it's like just like the accounting firm Ernst and Young sees the writing on the wall, and they don't want to go down as being among the people turn the blind eye to it, so they're covering their own ass. I think the same thing's happening with the media, the financial media. A lot of financial media is like, hey, this goes down in history as the bubble that it looks like it might be, like that is showing itself to probably be. We want to make it seem like we were on the right side of history, even though for the first 3 or 4 years of it, we were totally cheerleading and not doing our due diligence.
This isn't talking about the off-balance sheet accounting. This is talking about that other big giant accounting fraud. No, not the round tripping and the circle jerk economics. The other big accounting fraud that's associated with AI, and that is the hiding of depreciation expenses. In particular, the lack.
So the circle jerk accounting and circular accounting and depreciation expense, that's something that Michael Burry has been talking about a lot. These are all objections that I think they're going to struggle to redeem the narrative on, because they're not even like logistical things. Like, at least with the data centers and whatever, maybe they can sell some kind of new technology that's going to make it cheaper or make the compute more possible. But the accounting and the capex, that's going to be a hard one. And the lack of profitability, I think it's going to be hard unless they can promise to sell some kind of technology that's going to unlock all of that and unlock all the value and make the economics of it totally different. And I think quantum computing was supposed to be that, but it just didn't work. But they got to come up with something else. But I don't think they have anything in the wings that they've been working on that's ready to roll out to the public yet.
Of transparency and how these companies are artificially extending the useful lives of their equipment. Now, look, every penny of capex that a big tech company spends will one day result in a penny of depreciation expense, right? All the equipment that they're buying has a useful life, and eventually that useful life comes to an end. And in between, they've got to make a profit, which none of them are doing, not even close. They're actually losing money at ridiculous rates with this equipment. But this has basically been the gist of Michael Burry's short thesis. Dr. Michael Burry of Big Short fame, he was played by Christian Bale in The Big Short. He came out and he said, look, all these big tech companies have a tidal wave of depreciation expenses coming in the next few years. They're all lying or otherwise hiding.
And something that's crazy is Michael Burry started a huge argument on Twitter and was fighting with financial influencers over the weekend about his Substack. And by starting the fight with them, he got like 227,000 subscribers. I think he orchestrated this big argument to get attention. So now he has this paid Substack with like 200, like almost 250,000 followers, I believe. So what's going to happen? He's going to be feeding a lot of people these narratives. He's the one who I think has been playing a big role as well because of his high profile from The Big Short in normalizing and legitimizing these anti-AI narratives. So he's doing a lot to kill sentiment. And like I told you, I think sentiment matters more than fundamentals, because sentiment affects how people interpret fundamentals. So I think it's very interesting that he's doing that.
Big of a problem this is going to be for them. And that's the gist of Dr. Burry's short. And look, it makes sense. Every time they increase the useful life of their equipment, they magically create billions of dollars of equipment or of earnings by hiding their equipment expense. It's just one of many accounting frauds going on in AI. Oh, wait, we've got another one this morning. Yep, you get an accounting fraud. You get an accounting fraud. You do. SoftBank has come out and they said they swung to a profit last quarter. In particular, SoftBank says that they made $4.2 billion of profit off of their stake in OpenAI. Now, how did they make $4.2 billion in profit off of their stake in OpenAI? Because OpenAI does not make a profit. It is a cash incinerating inferno. It's where money goes to die. Well, here's what happened. The OpenAI raised money at a $500 billion valuation recently. And hey, as a matter of fact, SoftBank participated in that cap raise. They participated in that funding round. So SoftBank also participated in the prior funding round. So let me put this in plain terms, how SoftBank manufactured this profit out of thin air. Let's say I buy a Beanie Baby from you for $5. All right, I give you $5. I've got my Beanie Baby. And then I buy another Beanie Baby from you, an identical one, and I pay you $10 for this second Beanie Baby. And then I say, I just made a $5 profit on my first Beanie Baby because it's now worth $10 because the most recent one sold for $10. That is what OpenAI and SoftBank just did. And that is where SoftBank's profit came from. So there you go. You got another BS accounting measure going on today. the next best thing in the world. It's the greatest thing since sliced bread, artificial intelligence. It doesn't make any.
So these things were all, this guy was talking about all this stuff for years, and suddenly everything he's saying is being picked up by mainstream media, is being picked up by big accounting firms and being called out. And Michael Burry, who's like kind of the closest an investor has ever been to being a celebrity since Warren Buffett, is being seen normalizing and legitimizing these narratives. So it's a very different climate than it was 2 years ago.
Any money. It will never make any money, but somehow magically profit just keeps materializing out of thin air. Trust me, bro. And here I've been for almost 3 years now screaming about this. I thought I was the only one. Finally, somebody in the mainstream press is asking these questions after endlessly cheerleading for this garbage for years.
I feel like I'm taking crazy pills.
And I just love the Mugatu meme. I mean, it summarizes everything perfectly. All right, so that's the AI thing going on this morning. We've also got the U.S. and Japan is close to a deal, or close to working out the details of the prior deal, the trade deal that was or wasn't a deal, depending on which side of the aisle you're on. There was that $550 billion of investment in the U.S.
Hold on
that
one
was one of the
second.
terms to get President Trump to lower his tariffs on Japan and also dramatically reduce the tariffs on autos. That $550 billion appears to be steered towards energy, semiconductor manufacturing, and data centers. Oh, good. More money for data centers. That's just.
So the reason I let it play was because of that, the data center part. The data center part is the next problematic narrative that I don't see them having a answer for, but they're still trying to push forward with it. And I think right now Trump is kind of really obsessed with the bond market and how the treasury debt's going to roll over and managing the value of the dollar. So I don't think his attention is really focused on the stock market right now. I think he's going to have to fix that and the rolling over debt and defending the value of the dollar and the trade war before he can really start trying to prop up the stock market and Bitcoin. But by then it might be too late. It'd be very interesting to see.
That's what we need. Nothing in shipbuilding. Japan is the third biggest shipbuilder in the world behind South Korea and China. We have a massive shipbuilding disadvantage with the Chinese, and we are like sleepwalking into World War III on the Pacific with the Chinese. We've got $550 billion.
This guy buys into, I think he's conservative at the end of the day, so he buys into a lot of these xenophobic, these Chinophobic narratives, but he's very good at calling out the fuckery of the AI market.
Of investment coming our way from the world's third biggest shipbuilder. And what are we using that money for? Not to build ships. No, we're going to build more freaking data centers to run the chatbots. Hey.
Yeah. So there's one more part of this I want to jump to around 1610 mark, around here. Here we go.
Of them ultimately collapsing once again for your own good.
And after this, we're done.
So look, small platform, not a huge issue, but keep an eye on this. I think we're going to see a lot more of these. On to the big one of the day this morning. Meta auditor Ernst & Young raised red flag on data center accounting. Nice of you guys to show up to work today. Finally, somebody talking about this stuff. Meta Platform's latest annual report contained an unusual cautionary note for investors. The tech giant's auditor Ernst & Young raised a red flag over the financial engineering Meta used to keep a $27 billion data center project off its balance sheet. While EY ultimately blessed Meta's accounting treatment, the firm flagged it as a critical audit matter.
So that's crazy, man. Like Wall Street Journals is on the case now.
Or a CAM.
A lot of people read this.
This means it was one of the hardest, riskiest judgments the auditor had to make. Such a warning label is rare for a specific high-profile transaction at a major audit client. Meta moved the data center project called Hyperion off its books in October into a new...
At the end of the day, these people want to keep their clients happy. So you have to imagine how scary this was to them, for them to feel like they had to go on the record like this.
Joint venture with Blue Owl Capital. Blue Owl is like ground zero for the private credit bubble, by the way. Meta owns 20% of the venture. Funds managed by Blue Owl own another 80%. A holding company called Baynet Investor, which owns the Blue Owl portion, sold a then record $27.3 billion of bonds to investors. The joint venture is known as, in accounting parlance, as a variable interest entity, or a VIE. Meta said it isn't the primary beneficiary of the entity, and so it didn't have to put the venture's assets and liabilities on its own balance sheet. Meta's assertion that it lacks power over the venture is debatable and has drawn scrutiny from investors and lawmakers. Meta is a hyperscaler and knows how to run data centers for AI, while Blue Owl is a financier. Whether the venture succeeds economically will come down to Meta's decisions and know-how. In its report, EY said auditing Meta's decision was especially challenging due to the significant judgment required in determining the activities that most significantly affect the VIE's economic performance. In other words, Meta's full of shit, and the accountants or the auditors are covering their tracks by at least flagging this blatantly fraudulent accounting mechanism. 4 Democratic senators, including Elizabeth Warren, in a January 22nd letter, asked the Financial Stability Oversight Council, led by Treasury Secretary Scott Bessent, to investigate the risks that AI-related debt pose to the financial system. A growing share of these financing arrangements are convoluted and opaque, making it easier for companies to obscure the true nature of their balance sheets, they wrote.
So people are looking for this stuff now, which is a bad sign. Because if you're doing fuckery, once people start looking for it, it's pretty easy to find.
This joint venture with Blue Owl exemplifies this type of arrangement. So finally, somebody asking questions. It only took them 3 years. And as this is going on, we've got the Wall Street Journal also asking questions about other accounting here. Big tech accounting creates a blind spot in the AI boom. Depreciation expenses.
So 2 Wall Street Journal articles about big tech accounting.
Are about to soar, making a lack of transparency a growing problem. Remember, every penny of this capex will come back to haunt them in their earnings some later date when that capex is depreciated. Just 5 big tech companies are projecting to
Yes, another thing, the capex has to be depreciated.
spend a total of $3 trillion on property and equipment over the next 4 years, and that rapid growth is making it harder to analyze their earnings. The surge in capital spending for things like new gigantic data centers means depreciation expenses will be soaring in the coming years. Much of the equipment these companies are buying, such as chips for AI, will be gradually written down in value over 5 or 6 years, hitting profits. As capex has skyrocketed, controversies have occasionally flared over companies' moves to extend the useful lives of the assets they are depreciating. Even a small adjustment to an asset's useful life can have a big impact on earnings. Meta said its $60.5 billion of earnings last year included a $2.6 billion boost from lengthening the estimates for the useful lives of its servers and network assets. In other words, they just changed a line item on their balance sheet and poof, $2.6 billion of profit appears because we artificially extended the useful life of this equipment. One major issue, investors can't find depreciation expenses listed on the income statements for Alphabet, Amazon, Meta, Microsoft, or Oracle. Nor is there any consistency among the companies in how they choose to report these costs. While this is a problem across many industries, not just tech, it's becoming more acute at the biggest AI hyperscalers. Apart from Amazon, which has long operated a massive logistics network, these companies are transforming from asset-light to asset-heavy businesses. Contrast the tech companies' reporting methods with the long-standing approach by 2 railroads, for example.
I think they were going to get in bed with whoever they got in bed with. I mean, they were lobbying both sides of the issue. Like, I have no doubt. I mean, I talked about how crypto was lobbying both Kamala Harris and Trump. Like, I think Trump was seen as, clearly more corrupt and greedy. But I think Kamala Harris is also more predictable. Like, Kamala Harris would not have done all this stupid tariff stuff and weird trade war stuff and all this stuff. She would have just been unapologetically boosting to the economy with some token language about, like, liberal stuff, but yeah, I think in some ways she would have probably been better for these people. But I think whoever would have been in power would have been going along with the flow of this. I think the Dems, it was that the Dems didn't get ahead of it. I just think the Dems were losers, and people knew that Trump was more likely to win, and that the country was moving in a more Trump-like direction. But I think the DNC was just as willing to play ball as the Trump people, and it was just that they were just losers and they couldn't win.
In a quintessentially asset-heavy industry, Union Pacific and Norfolk Southern each report depreciation as a standalone operating expense on the income statement. That way, investors know the other expense lines don't include any of it. Big tech does not do that. So there's this massive negative earnings lurking on the horizon for all of these companies, which everybody is disproportionately allocated to, whether they realize it or not, because the concentration in the S&P 500 has become more acute than it's been, ever. And, accounting gimmicks, they're everywhere. And here's another one. SoftBank says it made $4.2 billion from its OpenAI investment in the last quarter. Now, how did they do that? By paying even more for another chunk of OpenAI. SoftBank, the Japanese tech investor that is aggressively pursuing what it calls artificial superintelligence, said on Thursday it recorded a $4.2 billion gain in the last quarter on its 11% stake in OpenAI. The OpenAI valuation surge is a bit circular. Yeah, there we go again with that circular. Just grab the joystick to your right and avoid eye contact, everybody. As SoftBank itself.
So you see another person talked about circular. That's another word that's now popping up all the time that used to never pop up. That's the thing when I say about it's all about narratives. It's all about sentiment. This stuff won't stop popping up. And just like all the pro AI talking points wouldn't stop popping up and we're propping up the bubble, now they won't stop popping up and they're weighing the bubble down. And again, you saw that guy Dario's face. He looks really creepy. He has a punchable face. I can't see him turning it around. Sam Altman's not going to turn it around. Elon Musk lost all credibility. He's seen as a creep, and him getting involved in politics was terrible. And the Doge stuff, and him co-signing every fascist conspiracy on Twitter. Like these guys, I don't know who's going to turn it around for them.
Participated in the October secondary share sale of $6.6 billion, where the ChatGPT maker received a $500 billion valuation. SoftBank now says it made a $19.8 billion from its investment in OpenAI. SoftBank says it closed the fiscal third quarter worth 30.9 trillion yen, or $197.6 billion, and says it's now worth 33.1 billion yen as of Wednesday's close. That implies the stock trades at a 19% discount to net asset value, maybe because everybody knows that net asset value isn't real.
Mm-hmm.
And again, guys, the analogy of the Beanie Baby. This is how SoftBank manufactured $4.2 billion of profit. I buy one Beanie Baby from you at $5. I buy the second Beanie Baby from you at $10, and then I mark up the first one to a $5 profit because they now trade at $10, even though it's just me doing it. That's how OpenAI and SoftBank manufactured a profit.
Yep.
OpenAI, by the way, loses money, in case I haven't said that over and over again.
Everything is fictitious capital now. That's why I say, like, the idea that fictitious capital is localized in Bitcoin is one of the biggest jokes. Like what he described, there's fictitious capital all over the place. And I think that's the biggest service that Bitcoin and places like that do to the elites, is that by it being the poster child for fictitious capital, it legitimates regular capital as the opposite, the place that is not fictitious. And you don't look to see just how fictitious the so-called regular markets are. It's what I call a false opposite. It's really a concentrated version of the main thing, but it paints itself as the opposite of the main thing. And yeah, I think it's a good place to stop. I just want to show one more thing. So this weekend, big short investor Michael Burry, he went short on Palantir and GameStop and did this long article about why Palantir, one of the big AI overvalued darlings, is going to go into the toilet. And it was like I think it was like 10,000 words, and he started arguing with all like the bullish financial influencer crowd on Twitter, and he got into beefs with them all weekend, argued with them, was blocking them, doing whatever. And at the end of it, he ended up with 227,000 plus subscribers on his Substack. So now what does he have? He has about 250,000 people incentivized to short these stocks. And I think it's kind of interesting. He's kind of creating the sentiment to back his play, because he's predicting a play, he's making cases for it, then he's like making spectacle around it and getting paid subscribers to his Substack, where he's going to keep selling the idea of this, and he's going to basically incentivize a lot of people to short the thing, which I think is going to end up making it come true. So that's another big narrative former out there in the wings going against AI. And this is not me saying that AI is definitely going to crash, because I don't believe in making predictions like that. And even though I think it, probably should, based on the fundamentals, I don't think fundamentals really matter, except to the extent that the sentiment is bad enough that people allow them to matter. And something like, as everything stands now, I think that's definitely the case, but a lot of stuff can happen. The problem is I can think of a million bad narrative things that can come up, but very few good narrative things that can come up. But the good narrative things do exist. And one of them I think is like emergency rate cuts, and a couple of other things, but not many. So just be cautious out there. Be smart. Think of the things that we said. And just because a lot of this is bullshit doesn't mean that it can't keep going up. Like, be very, very, very careful shorting, because shorting can be like infinite losses. Shorting is very dangerous, because shorting requires people to be smart, and a lot of people are incentivized to believe the bullish case. You know, people can be irrational for a very, very long time. So be very, very careful on shorting. I don't recommend shorting. You can be left trapped holding the bag, because I don't want to underestimate how gullible people are. Even though I can't imagine what the narrative would be, I'll turn it around. There might be something out there. You never know. And if it happens, you'll get trapped under a stock market that just seems to keep rising for the next couple of years. And you're just watching your short go redder and redder. Yeah. So, yeah, everyone, thanks for joining us. See you on Thursday at 7. And that one probably won't be about business. It'll be about something cultural. I think that's probably how we're going to go back and forth. But yeah, keep watching, keep liking, keep sharing, subscribing. It helps us get remonetized. Definitely get your friends to watch us. It's definitely helpful to us. All right, everybody, be good. Love y'all. And you could have been anywhere tonight, and you chose to spend it with us. And I appreciate that. Later.